welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic of earnings per share, and specifically want us we discuss on what is diluted earnings per share and the computation of the same. So diluted earnings per share, this is the earnings per share which is computed by those companies which have issued potential ordinary shares. So potential ordinary shares are what? These are those securities which will have been issued by the company at the end of the year, or contracts which the company will have entered into and which requires the company to issue ordinary shares in the future. A good example of a potential ordinary share is convertible securities like convertible debentures or stock options which are granted to the employees and which are to be exercised in the future. Definitely, once these particular potential ordinary shares are converted into ordinary shares of the company, then the interest of the original shareholders will be diluted. And therefore, International Accounting Standard number 33 requires any company having potential ordinary shares to compute diluted earnings per share and disclose that as part of the notes together with the basic earnings per share. So therefore, it is important to note that this diluted earnings per share is only computed by those companies which have the potential ordinary shares. So therefore, we can say that DEPS is computed by entities which have potential ordinary shares, e.g. convertible debentures, comma, share or stock option, options, etc. So the reason why these companies are required to compute now the diluted earnings per share is because once these potential ordinary shares are converted into ordinary shares, then the interest of the original shareholders will be what? Will be diluted. That's why we are saying is a requirement by IAS 33 for these companies to do what? To compute the diluted earnings per what? Per share. So we can say IAS 33 requires companies or entities having potential ordinary shares, that is abbreviated as POS, potential ordinary shares. IAS 33 requires entities having potential ordinary shares to compute and disclose DEPS together now with the basic earnings per share. So this diluted earnings per share, we said it must be disclosed as part of the note now to the financial statement. So therefore, any company having POS is a requirement. It has to do what? To compute and disclose what we refer as what? The diluted earnings per share. Why? This is because once the POS, the potential ordinary shares, are converted into ordinary shares, the interest of original shareholders will be diluted. And therefore, by computing now the earnings per share, the diluted earnings per share, what the company will be doing, it will be communicating to the shareholders of the company of the earnings per share, or basically the effect of the earnings per share, the effect on the earnings per share once these potential ordinary shares are converted into ordinary shares. If, for example, a company has issued a convertible debentures, we know that the holder of these particular debentures will convert them into ordinary shares. So once they convert them into ordinary shares, so what will be the implication of that to the earnings per share of the original shareholders? That's why we are saying that these particular companies which have potential ordinary shares is a requirement under IS 33 for them to compute and disclose what we refer to as the diluted earnings per share, together with what? The basic earnings per what? The basic earnings per share. So how is diluted earnings per share computed? So maybe you can just look on the computation of diluted earnings per share. How do we compute the diluted earnings per share? So in computing this DEPS, we compute it, or basically it's computed on the assumption that the potential ordinary shares of the company were converted into ordinary shares. Basically what that means is that if, for instance, you're given some information, you're told the company has issued convertible debentures, then for you to compute DEPS, you do what? You assume they were converted into ordinary shares during the current year, and now you ascertain the implication, or basically the effect of that conversion of convertible debentures into ordinary shares on the earnings, or basically the profit attributable to ordinary shareholders, and also you ascertain the implication, the effect of that conversion on the weighted average number of ordinary shares. So that is very, very important, that this earnings per share is computed on an assumption that the potential ordinary shares were converted into ordinary shares. So that is maybe the first important point we can say, that DEPS is computed on the assumption that potential ordinary shares were converted into ordinary shares during the current year, during the current year. And once that particular assumption is made, then I've said that we need to ascertain, or basically an entity will need to ascertain the implication of that. If this convertible, for example, the convertible debentures were converted into ordinary shares, so what would be the implication of that, both to the profit attributable to ordinary shareholders, and also what would be the implication of that to the number of ordinary shares issued by what? By the company. Like, maybe let me just illustrate what I mean by that. Let me illustrate here. We assume that a company, or we are given some information that a company has issued, for example, 8% convertible debentures, debentures having a value of like 5 million shillings, 5 million. So for us to be able to compute now the diluted earnings per share, given such information, then what we do is that we assume that these particular convertible debentures were converted into ordinary shares during the current year. If that was the case, then that would have or that will affect the profit attributable to ordinary shareholders, and two, the number of ordinary shares issued by this company will do what? Will reduce. Sorry, will increase, that is. And therefore, what you do once you assume that this particular convertible debentures were converted into ordinary shares, you proceed, you compute two items. One, you determine something called the increase in earnings. And number two, you also determine something called the increase in number of shares. So first of all, when we talk about the increase in number of shares, we are referring to the number of ordinary shares which would have been issued by the company on the assumption that these particular convertible debentures were converted into what? Into ordinary shares during the current year. In terms of how we compute this, is very simple, because what you just do, you use the conversion rate. Use the conversion rate which is provided to you by the examiner, to compute the number of ordinary shares which would have been issued on the assumption that those particular debentures were converted into ordinary shares. Then also determine something called increase in earnings. What is increase in earnings? Increase in earnings, this refers to the amount by which the profit attributable to ordinary shareholders would have increased with, on the assumption that these particular debentures were converted into ordinary shares. And if these debentures were converted into ordinary shares, it means that the interest payable on these particular debentures, that interest would not have been paid. In other terms, the company would have saved because that interest would not have been paid. And therefore, the profit attributable to ordinary shareholders would have increased with the interest which was paid by the company during that year, interest paid. And because this particular interest paid is tax allowable, then we take that interest net of tax. So to get the interest net of tax, we multiply that with 1 minus what? Tax rate. So therefore, what we are saying here is that in computing the diluted earnings per share, we assume that the potential ordinary shares were converted into ordinary shares during the current year. Once you make that assumption, then go ahead and determine the amount by which the profit for the current year would have increased with. And number two, you determine the number of ordinary shares issued by the company would have increased with how many shares. And once you determine these two items, then you proceed and automatically compute the diluted earnings per share, of which to compute the DEPS, we take the PATOS, profit attributable to ordinary shareholders, which is used in the computation of basic earnings per share, and then to this you add the increase in earnings. Increase in earnings, I've explained what we mean by that there, and then divide that with 1/0, still used in the computation of basic earnings per share, and then to this you add increase in number of shares, and equally I've explained what we mean by increase in number of shares there. So that is the general formula, or basically the formula which is used in computing the DEPS. In computing what? The DEPS. Now, from there, we proceed and we look on specifically how we deal with the various types of potential ordinary shares in computation of diluted earnings per share. And I want us to start by looking on the treatment of the first type of potential ordinary share, and that is the convertible debentures, or convertible bonds, or even convertible own stock or own notes. So these ones are treated in the same way when computing the diluted earnings per share, because these are types of potential ordinary shares. So if you come across some question and you're told the company had issued convertible debentures, convertible bonds, convertible own stock, the first thing you need to recall is that this is a potential ordinary share. These are financial instruments issued by the company, which require the company to issue ordinary share in what? In the future. For you to compute the diluted earnings per share, you basically assume that this particular convertible securities were converted into ordinary shares during the current year. Once you make that assumption, then you proceed, you compute two items. The increase in earnings. This refers to the amount by which the profit for the current year would have increased with, on the assumption they were converted into ordinary shares. And in terms of how we compute this, we take the interest which was paid, or compute the interest which was paid by the company during that year, and then you multiply that interest with 1 minus tax rate. Reason being that this interest is tax allowable. That's why we are getting that interest net of what? Of tax. And then also you compute something called the increase in number of shares. Increase in number of what? Shares. So, and to compute the increase in number of shares here, I've said just use the conversion rate provided. Use conversion rate provided. Use the conversion rate which is provided. But in this case, in computing this particular increase in number of shares, it is also important to note that if these convertible securities issued by the company were outstanding at the start, meaning that these convertible securities had been issued when the year was starting, then we assume that the conversion equally would have taken place from the start of the year. And that means that those shares which would have been issued on conversion, the number of ordinary shares which would have been issued on conversion would have been held for the whole year. For the whole what? Year. So those particular shares, don't weigh them on time basis because they would have been held for the whole year. But if a convertible security was issued in course of the current year, for example, the company issued convertible securities, convertible debentures, maybe 6 months to the end of the year. 6 months to the end of the year. So in that case, we assume if they were converted into ordinary shares, they would have been converted from the date of the issue. Meaning that the number of shares which you are going to get, which would have been issued on conversion, you have to do what? You have to weigh them on time what? Basis. You have to multiply them with the proportion of time they would have been held, because automatically those shares would not have been held for the whole what? Year. They would have been held from the date of conversion, which is the date of the issue, to the end of the year. So that is how first of all we treat the convertible debentures, convertible bonds, convertible loan stock in computing the diluted earnings per share. Number two, we have convertible preference shares, preference shares. So this is still a potential ordinary share. Reason being that these preference shares are convertible, means that the holder of these particular preference shares can convert them into ordinary shares. So equally, if you come across a question, you're told a company had issued convertible preference shares, for the purpose of computing DEPS, you assume those convertible preference shares were converted into ordinary shares during the current year. As a result of that, you proceed equally compute the two items. You compute, number one, increase in earnings, of which the increase in earnings here is equal to the preference dividends, paid during that year, preference dividends paid during that year. And then number two, you determine the increase in number of shares. So equally to determine this increase in number of shares, what you do, you equally use the conversion rate. Use the conversion rate provided. Use the conversion rate which is provided. And equally, what I've said here, if the convertible preference shares were issued in course or during the current financial year, you assume the conversion would have taken place from the date of the issue. Basically, what that means that the number of ordinary shares we are going to get as one or as the shares which would have been issued on conversion, what you do, you have to weigh them on time basis. You have to multiply them with the proportion of time the shares would have been held during that year. Then let's proceed and look on how we compute or how we treat the other type of potential ordinary share in computing DEPS, and that is the share or stock options. So when talk about the share or stock option, we know that this basically a privilege is a right which is given to the employees of the company to buy the company shares in the future at a price which is below the market price. Equally, in computing the diluted earnings per share, we assume that these stock options or the share options were exercised during the current year. The employees of the company bought the shares of the company during the current year, but at a price below the market price. So therefore, what you do, you equally have to proceed and you determine the two items. Number one, increase in earnings, of which the increase in earnings, as far as these potential ordinary shares are concerned, then increase in earnings is always equal to zero. Reason being that here the employees of the company are just granted an option or a right or a privilege to buy the shares of the company in the future at a price below the market price. As a result of the employees being given that right, they are not entitled to any form of return until the time they buy the shares. So therefore, even if they bought those particular shares of the company during the current year, that action by the employees will not affect the profit attributable to ordinary shareholders, simply because they are not entitled to any form of return. So by exercising that option, the company will not save anything, so the profit attributable to ordinary shareholders will not be affected. It will not increase. That's why we are saying increase in earnings for stock option is always equal to 0. And then number 2, we determine the increase in earnings. Remember, the increase in number of shares, not increase in earnings. Increase in number of shares. This one we have said refers to what? To the ordinary shares, which definitely would have been issued to the employees of the company, assuming they exercise this right, this privilege during the current year. And what we know is that if the employees exercise their option during the current year, then they would have been issued with the shares of the company at a price below the market price. So therefore, what we do here is, number 1, we determine the shares which would have been issued to the employees at full market price. That is the issue at a full market price, assuming they exercise the stock option during the current year. And in terms of how we determine these shares issued at full market price, first of all, we compute the amount which would have been received by the company from the employees, and then divide that with the average MPS, average market price per share. Now, these particular shares, because they are issued at full market price, these shares, we say they are not dilutive. Not dilutive. So not dilutive means that they do not reduce the earnings per share. These are the shares the company issue. The company receive additional resources, receive an amount of money from the employees. That money is invested. By the end of the day, the profit of the company do what? Increase. And equally here, the number of shares increases. So here we are increasing both profit and also the earnings per both the profit and the number of shares. So therefore, these shares issued at full market price, they do not reduce the earnings per share. And therefore, these shares here, for the purpose of computing the DPS, are ignored. So these shares are ignored for the purpose of computing DEPS. We don't consider them. So what we consider is now the other element, number 2. And the other element, number 2, is what? Is the bonus shares. Bonus shares. So the bonus shares, this refers to those particular shares which would have been issued to the employees of the company, assuming they exercise the stock option, the right, during the current year, but free of charge. So how do we compute this? So number 1, we take the total shares which would have been issued to them, assuming they exercise the stock option during the current year, and then deduct the shares which would have been issued to them at full market price. And the shares issued to them at full market price is computed using this formula. So we deduct issue at full market price. Now, these particular shares are the ones which are dilutive, So meaning that these shares reduces the earnings per share, because what happened here, the number of shares issued by the company increases, there is no any increase in profit. So generally, we know in computing the earnings per share, you take the profit attributable to ordinary shareholders divided that with number of ordinary shares. So here we are saying the company is just increasing the number of shares issued, but the profit remains constant. The profit does not change. What is the effect of that to the earnings per share? The earnings per share automatically will reduce. That's why we are saying those shares are dilutive. And therefore, these are the shares which are used in computation of the diluted earnings per share. So therefore, the increase in earnings here, as far as the stock or share option is concerned, we say this is equal to the bonus element or the bonus shares. So those shares which are issued free of charge are the ones which are considered here. And you also have to remember that the bonus shares, how do we compute them? We take the total shares which would have been issued to the employees, assuming they exercise the stock option during the current year, minus the issue at full market price. Full market price. And also it is important for me to mention here that this particular bonus shares, we consider them as dilutive. We don't treat them as shares issued free of charge. Here, for the purpose of computing the diluted earnings per share, we treat them as what? As dilutive number of shares. So meaning that if this particular stock option or the share option was granted to the employees during the current year, then the dilutive number of shares which you get here, which are equal to the bonus shares, those shares will also be weighted on time basis. If the stock option, if the share option was granted to the employees during the current what? During the current year. So that's basically how we deal with the share or the stock option. And then next we have number 4, we have partly paid shares. Partly paid shares. So partly paid shares, these are those shares issued by the company at full market price, but at the end of the year, the shares will not be fully paid. So these particular shares are only considered to be potential ordinary shares, if by the time the shares will be fully paid for, the market price per share will have increased. That is the only time we consider them to be potential ordinary shares, and therefore we use them in computing the diluted earnings per share. But if by the time the shareholders will be fully paying for these shares, the market price will not have changed, they are not considered to be potential ordinary shares. So therefore, they are only considered to be potential ordinary shares when or we can say they will only be considered to be potential ordinary shares if by the time the shares will be fully paid for, the shares will be fully paid for, the market price per share, will have increased. Market price per share will have what? Will have increased. And therefore, in such a case, what you do is that you compute those particular shares which will be issued free of charge. Because if, for example, the shares were issued to the employees, to the shareholders, or even to the members of the public at a price of like 20 shillings, and maybe at the end of the year, the shareholders will not have fully paid for their shares. Let's assume that those shares which will not be fully paid for at the end of the year are 1 million. So, but now at the time they will be paying for these shares, the market price will have increased to 40. So remember here the shareholders will still pay the price of 20 because the shares were issued to them at a price of 20. But at that time, the moment they are fully paying for their shares, the shares are trading at a price of 40. So meaning that they will pay a price which is less than the market price per share. And basically the concept for share or stock option also applies here. Some of the shares will be deemed to be issued to them at full market price, whereas other shares are deemed to be issued free of charge. So therefore, what you consider here are the shares which will be issued to them free of charge. You consider the bonus elements or the bonus shares. So in the bonus shares, the formula is just the same here. So the total shares which will be paid for, total shares to be paid for, minus the shares which will be issued at full market price. So assuming this is the information we are given, the shares now which will not have been paid for are 1 million. So these are the shares now to be paid for by the shareholders, and then to this you less the shares which will be issued to them at full market price, which will be 1 million times the amount they are going to pay per share, and then divide that with what? With 40. So these are the shares which will be issued to them at a full market price. Automatically, that means that the other shares, which I think should be what? Should be 500,000. So these particular shares will be issued to them free of charge. And these are the shares now which we consider in computing the diluted earnings per share. So therefore, as far as the partly paid shares are concerned, it is important to know that these are only considered to be potential ordinary shares if by the time the shares will be fully paid for, the market price will have increased. If that is the case, it means that the shareholders, the existing shareholders or the shareholders issued with those shares, they will pay a price which is less than the market price, and therefore you have to determine how many shares will be issued to them free of charge. And basically what you do, that is what you consider the bonus shares. And automatically here, because this we are saying is equivalent to stock option or share option, the increase in earnings for such shares, increase in earnings for such shares is always equal to zero, So finally, I want us to look on how we treat the other type of potential ordinary share, and that is the contingently issuable shares, which should be number 5. Contingently issuable shares. So this is something we defined in our first class, or in our first lesson of this particular topic, and we said contingently issuable shares. These are those particular ordinary shares to be issued by the company in the future upon fulfillment of certain conditions. For example, in this case, we said the senior managers of the company can be promised to be issued with the shares either free of charge or at a little consideration upon satisfying certain conditions. And therefore, these particular shares will only be considered to be potential ordinary shares, and therefore used in the computation of basic earnings per share if two criteria have been met. Number one is that the condition agreed between the company and the senior managers, that condition has been met. If the condition was that the senior managers will be issued with the shares either free of charge or at nil consideration once the profit of the company exceed a certain amount, for these shares to be considered as potential, that condition must have been met. The profit must have exceeded that particular amount. And number 2, or the other criteria, is that the shares have not been issued. Shares have not been issued. And in most of the cases, because now these particular shares will be issued at a price which is below the market price, we treat these particular shares, contingently issuable shares, as an equivalent of share or stock option. So mean that in computing the diluted earnings per share, we assume that these shares were issued during the current financial year to the, for example, senior managers. As a result of that, you compute the two items, the increase in earnings, which will automatically be zero because we are saying this is equivalent to a share or stock option. Here the shares are issued to the senior managers at a price below the market price. So the increase in earnings is equal to zero. What about the increase in number of shares? Increase in number of shares is also equal to the bonus element. Those particular shares which would have been issued to the senior managers free of charge. The formula for computing the bonus element remains the same as the ones we have discussed here. So the total shares which would have been issued to the senior managers minus the shares which would have been issued to them at full market price. So basically that's how we treat different types of potential ordinary shares in the computation of diluted earnings per share. And those concepts we have discussed here are very, very important because you need to recall them in tackling any question for DEPS. So I want us to stop at that point. Once we come back in our next session, we are going to look on an illustration question which is based on a past paper question. Hi candidate, welcome to another session of Manifested Online Classes. And I want us to continue with the topic of earnings per share. So this is our lesson number 3. In the previous lessons on the same topic, we defined what is earnings per share. We looked on the significance, or basically the benefit of earnings per share. And also we were able to define some few terms. In lesson number 2, we defined what is basic earnings per share. and actually looked on how basic earnings per share is computed, and also we discussed on some of the reasons as to why the number of ordinary shares issued at the start of the year may change. So in this session, I want us to do an illustration question regarding the computation of basic earnings per share. And that illustration question is based on a past paper question, and the question is November 2019, which is question number 5A. So we go through the question and then we see what the examiner was requiring. So the question reads, Dakika Limited has prepared its consolidated financial statements for the year which ended 30th September 2019, extract of which are shown below. Also provided below are extract of the consolidated financial statement for the year to 30th September 2018. So we are given some information for 2 years, the year which ended 30th September 2018 and 2019. So number one, we have profit before interest and tax. We have the finance cost. We have the tax charge. We have the ordinary dividends paid, preference dividends paid, and profit attributable to non-controlling interest. And then you're told you have also obtained the following information in respect of company's share capital. Number one, you're told the ordinary shares as that is ordinary share capital as at 1st of October 2017 was shillings 15 million, made up of shares of shillings 5 per value. Number two, you're told Dakika Limited issued some 500,000 shares at full market price on 1st of January 2018. And number three, we are told Dakika Limited also made a right issue of two new ordinary shares for every 10 ordinary shares held as at 1st April 2019. The right issue price per share was shillings 42.5. Market value per share as at the same date was shillings 48. Number four, we are told Dakika Limited also had 1 million 6% shillings 10 per value non-redeemable shares as at 1st of October 2018. So from that particular information, what the examiner was requiring, number one, is we compute the basic earnings per share, BEPS, for the year which ended 30th September 2018. And number two, we compute the the basic earnings per share for the year which ended 30th of September 2019. So here we are required to compute the BEPS, basic earnings per share, for 2 years. And what we said is that in computing the basic earnings per share, we take the profit attributable to ordinary shareholders, we divide that with the weighted average number of ordinary shares. In other terms, we take the patos, divided that with what? With the one-offs. So that is the first thing we need to have here. That is a formula for computing the BEPS for the first year which ended 30th of September 2018. So the formula here is that we take the patos, which in full is the profit attributable to ordinary shareholders. We divide that with one-offs, weighted average number of ordinary shares. So we need to compute these two items. We start by determining the profit attributable to ordinary shareholders. And we start with that for the first year which ended 30th of September 2018. So in terms of how we compute this, we said we take the profit for the year, or the profit after tax, less the preference dividends for that year, and then we less any profit attributable to non-controlling interest. So what you're given in that particular question, we don't have the profit after tax, but we have the profit before interest and tax. So what we need to do for us to get the profit after tax, we take that profit before interest and tax, we less interest, and also we less now the tax, so that we get now the profit after tax. So to get the profit after tax, so we're going to take the profit before interest and tax, and we are starting with the year 2018, which is given as 7012. So to this we less the interest, which in other terms we refer to as the finance cost, and then we less tax, which is 1264, and that now will give us the profit after interest and what? After interest and tax. And then to this we also less the preference dividends, preference dividend. You also have to recall what we said in our previous session, that if the preference shares issued by the company are redeemable, we don't less their dividends here because they have already been deducted in arriving at this particular profit as part of the finance cost. But in the additional information number 4, we are told that preference shares issued by this company, they are non-redeemable. They are non-what? Redeemable. So therefore, you're going to less those particular dividends here, and you are given the dividend 60,000, and then to this we also less the profit attributable to non-controlling interest. We have that particular figure as a figure of what? 160. So whatever you're going to get here is what we refer to as the PATOS, the profit attributable to ordinary shareholders. So let's compute that, but we need to first of all determine the profit after tax, which is 7012 minus 60 minus 160. Okay, sorry. We take 7012 minus 987 minus 1264. So that will give us a figure of 4761, and then we less these two items. We less 60 and also we less 160. So we get 541. So 4541, this is what? The profits attributable to ordinary shareholders. So in our case, we already have that. So next, what we need to do is to determine the weighted average number of ordinary shares. And for us to compute this, that is the weighted average number of ordinary shares, we said we take the ordinary shares issued and fully paid at the start of the year. And this particular year, which was ending 30th September 2018, this year started on 1st of October 2018. That is when the year started, not 2018 here, but 2017. And that year ended 30th of September 2018. So therefore, to compute the one-off weighted average number of ordinary shares, we take the shares issued at the start of the year, and then we add the other shares which were issued during that particular year. In our previous session, we also discussed on how we treat the various types of shares which are issued during a certain financial year or in a certain financial year. So you have to recall what we discussed in our previous session. So what you are given, if you go to the note number 1, you're told the ordinary share capital of this company is at 1st of October 2017 here is 15 million, made up of shares of 5 shillings per value. So basically what you're given here is the share capital of the company, which was 15 million. So therefore, to compute the one-offs, we take the shares issued and fully paid at the start of the year, which we are saying started on 1st of October 2017. So, and the shares issued and fully paid at the start of the year, we can refer to that as balance brought down. So what we do, we work with our figure still in thousands of shillings. So for us to be able to determine the shares issued and fully paid at the start of the year, we take the share capital, and we have to be very keen that 15 million, these are not the number of shares, because our interest here are the shares issued and fully paid at the start of the year, but this is the total value of the shares. So therefore, for us to get the shares issued and fully paid, we take 15,000 divided that with 5, which is the par value per share, and basically this should give us 3,000. So those are the shares issued and fully paid at the start. Then what we have to do is we check during this year, were there some shares which were issued? So let's take the information which are given in note number 2. You're told Dakika Limited issued 500,000 shares at full market price on 1st of January 2018. 1st January 2018. So you can see 1st January 2018 is within the first year, because here we are given information about 2 years. So you have to check whether that transaction occurred in the first year or in the second year. So therefore, this one occurred during the first year. That is 1st January 2018. So we say there was issue of shares, or basically ordinary shares, at full market price. Issue at full market price. Now, these particular shares which are issued at full market price, we said in terms of how we treat them, for the purpose of computing the basic earnings per share, we weigh them on time basis. We multiply them with the proportion of time they were held during that year. So these shares were held from January of 2018, actually 1st January, to the end of or to 30th September. So here automatically we have 9 months, because from January to the end of September, 9 months. So therefore what we need to do is to multiply these particular shares on time what? On time basis, or basically based on the proportion of time they were held during that year. So we have 500,000 times 9 divided by 12. That will give us 375. So and then from there we have the other transaction, note number 3. We are told Dakika Limited also made a right issue of 2 new ordinary shares for every 10 ordinary shares as at 1st April 2019. 1st April 2019, is it within the first year here? No, that is not within the first year, because we also have to recall we are given information for second year, which ended on 30th September 2019. That is September 2019. So therefore that transaction regarding the right issue is a transaction for the second year. So we are going to consider that in computing the BEPS for year 2. And then note number 3 is about the preference shares. Do we consider the preference shares here in computing the basic earnings per share? No. So therefore in our case we can get now the one-offs. The one-offs by adding these two, which will give us 33.75. So in our case, it basically means now we have the 2 items which we require. We have the patos, and then we have what? The one-offs. So having that, we can then proceed and we compute the basic earnings per share, which will be equal to patos 45.41 divided that with one-offs 33.75, and that now will give us the earnings per share, the basic earnings per share. So the basic earnings per share will be 45.41 divided by 33.75, and this will give us shillings 1.345, which is shillings per share, So basically that is it, that what is required as far as the Roman 1 is concerned. And you can see the marks which were located there are 4 marks. Mostly what will be marked here is the patos. Were you able to get that figure correctly? And also this. Were you able to determine the shares issued and fully paid at the stand? And also were you able to treat or basically to deal with those particular shares issued at full market price? Basically by doing that, you get your 4 marks. So let's move to Roman 2 of that particular question there, whereby we are required to compute the basic earnings per share for year 2, which ended 30th of September 2019. So Roman 2, BEPS, basic earnings per share for the year which ended 30th of September 2019. So the formula for computing this remains the same. We take the patos all of our notes. We don't need to repeat the formula because the formula is not marked. So, but what we need to do is to determine these 2 items, the patos and one-offs. So let's start by determining the patos for the second year. So the procedure is the same. Take the profit after tax minus preference dividends minus the profit attributable to ordinary shareholders. So the profit after tax, equally this one is not given, but we are going to compute it in the same way. We take the profit before interest and tax, which is given as 830, minus the finance cost or minus the interest, 1045, minus the tax charge, which is 1718, and basically that will give us the profit attributable to ordinary shareholders. Not the profit attributable to ordinary shareholders, but the profit after tax. And then to this we less the preference dividends, and also we less the profit attributable to non-controlling interest. So the preference dividends still is a figure of 60 as the first year. The profit attributable to non-controlling interest is 180. So this will give us now the patos. So let first of all we work out the profits at the profit after tax, which will be 8830 minus 1045 minus 1718, so which will give us 67, and then to that we less 60 preference dividends and profit attributable to NCI, which will give us 5827. So in our case, we already have now the patos. Next, we need to proceed and we determine the wanos. Wanos, weighted average number of ordinary shares. So we know that the second year here started on 1st of October 2018. That is when the year started, 1st of October 2018. So what we need to do is to determine the shares issued and fully paid at the start of the second year. So this is something which the examiner will not have given you. Anytime you're given information about 2 years, is upon you to determine the shares issued and fully paid at the start of the second year. Where do you get that information? That information is not in the question. You get it from the computation you did in the previous year. So from the previous year, we know the shares which were issued and fully paid at the start were 3,000. So you take those shares, 3,000, and then you check during that year, were there other shares which were issued? Yes. So we have these shares, 375. But now what you do, you take the actual shares. The actual shares were not 375, but the actual shares were 35, because those shares as at the start of the second year will be issued and fully paid. So therefore, you take the actual shares and basically you add them to the shares issued and fully paid at the start, which will give us 35. And then you check during the second year here, was there other shares which were issued? Yes. So in note number 3, we are told on 1st of April 2019, there was a right issue. There was a right issue. Remember, you said in our previous session that this is a very, very common concept, a very, very important concept which is tested in almost all questions for earnings per share. So, and what we said is that during a right issue, the company issues additional shares to the existing shareholders of the company at a price which is below the market price. As a result of that, we said those shares which are issued to the existing shareholders of the company, some of them are deemed to be issued free of charge, whereas others are deemed to be issued at full market price. And therefore, we said these shares issued during the right issue, we have to split them into two components, into shares issued at full market price and the shares issued free of charge. But for us to do that, we need to compute two items. Number one, we need to determine how many shares were issued by the company during the right issue. And number two, we also compute something known as theoretical ex-right price, which we said is the expected market price per share after the right issue. I gave you the formula for computing the same. So therefore, what we need to do as far as this right issue is concerned, we need to compute two items. Number one, the shares which were issued by the company during the right issue, because we are not given that. How many shares were issued during the right issue? So as per the information we have in note number 4, we are told during the right issue, the company was to issue 2 new shares. The company was to issue 2 shares for every 10 shares, which were held, for every 10 shares which were held. So what we need to do is to ask ourselves, before this particular right issue was made, how many shares were held? And equally, you can't get that in the question, you can only get that from your computation. So before this right issue was made, you can see the shares which were held or which had been issued by the company were 3,500. So those are the shares which were held. So we need to determine how many shares were issued during the right issue. We cross multiply, then we divide. 2 times 3,500 divided that with 10. So this will give us 700 shares. So these are the shares issued by the company during the right issue. Those are the shares we are going to split into 2 components. Shares issued at full market price, shares issued free of charge. But before we do that, we need to compute something known as theoretical X-right price. This is something which the examiner will not have given you. You have to compute that. So there is a formula which we use and which you covered in FM, Financial Management Intermediate level, but I gave a very simple approach of computing this in the previous session, because if you go back to the information which we have, there is some information or some details I want us we get there from note number 3. We are told in the last sentence of note number 3, the right price per share was 42.5. So mean that because during the right issue, the company was to issue 2 shares for every 10 shares which were held before, these 2 shares which were to be issued by the company during the right issue, each share was to be issued at 42.5. But now, the shares which were held, or basically the market price per share before the right issue was 48. So that information, we need to have it here. So and therefore, once you have that information, we said you come here and you say, before the right issue, if you held 10 shares, and each share was trading at 48, that's what we know, then during the right issue, as a shareholder of this company, you are to be issued with 2 shares. Record the shares there, 2 shares at a price of 42.5. At a price of 42.5. So basically what that means is that after the right issue, as a shareholder of this company, you'll be holding 12 shares. If you held 10 before, after you'll be holding 12 shares. And what will be the total market price of these 12 shares? To get the total market price of those 12 shares, we need to multiply this and this, which will give us 480, and then 2 times 42.5, which will give us 85. So and then we add the 285 plus 480, which will give us 565. So basically what that means is that after the right issue, a shareholder will be holding 12 shares, and the total market price of those 12 shares is 565. So what is our interest? Is the market price of 1 share after the right issue. So which is equal to the price of 12 shares, and then we divide that with the 12, so that we get the market price of 1 share after the right issue. So that will give us 47.08. So this is basically the theoretical X-right price, the market price per share after the right issue. And I think having that now, what we need to do is we proceed and we split these shares into 2. The shares which were issued during the right issue, we split them into 2 components. Number 1, we determine the shares issued at full market price. And we said in terms of how we compute this, we compute, first of all, we determine the amount received by the company from the right issue, which will be equal to the shares issued during the right issue, 700, times the amount which was to be paid per share during the right issue. The shareholders were to pay 42.5. Then divide that with theoretical X-right price, which you have computed down there, 47.0833, that is 0.83. And because these particular shares are issued at full market price, the rule is that they should be weighted on time basis. They should be multiplied with the proportion of time they were held. So these shares were held from April to September. So how many months do we have there? Those should be 6. So we have April, May, June, July, August, and September. So we have 6 months out of 12. Make sure your computation there is correct. And then finally, we compute the bonus shares. Bonus shares, these are shares issued free of charge. We looked on the formula and we said we take the total number of shares which were issued during the right issue, 700, minus the shares issued at full market price. The shares issued at full market price is what we have here. Not the final answer you get here, but what you have here. In fact, just transfer this here. These are the shares issued at full market price, 700 times 42.5 divided by 47.083. And equally, we said that these particular shares, we don't weigh them on time basis. We don't weigh them on time what? Basis, because they are shares issued free of charge. Yes, so let's first of all determine the shares issued at full market price, 700 times 42.5 divided by 47.03083, which will give us 631. 631. Okay, let's take that again. So we have 700 times 42.5 divided by 47.083, okay, times, or basically divide that with 2. So that will give us 315.9. 315.9. Can we take it to as 316? Yes, let's take it as 316, and then we compute the bonus element here. So we have 700 times 42.5 divided by 47.083. Okay, and then we deduct that from 700, which will give us 68, around 68 to the nearest whole number. Remember, these shares are not weighted on time what? Basis. Yes. And I think now with that, we can be able to get the one-offs, the weighted average number of ordinary shares, by adding all what we have there, 35 plus 316 plus 68, which will give us 3884. 3884. Basically, what that means now, we have the one-offs, we have what? The patos. Having that, finally, let's compute now the BEPS, the basic earnings per share, which will be equal to the patos, profit attributable to ordinary shareholders. We divide that with the one-offs, which we have here, 3884. So this will give us what? This will give us an amount of what? That is 5827 divided by answer, which will give us 1.50, 1.5 what? 0. So that is it. Basically, that's what was required as far as that question says is concerned. And how many marks were allocated in that particular question there? 6 marks. So definitely 1 mark, or basically this was one of the items to be marked there, the profit attributable to ordinary shareholders, determining the number of ordinary shares issued and fully paid at the start of the year, and also computing the number of shares issued during the right issue, splitting them into 2 components, into shares issued at full market price, the bonus element, and also this particular price here, the theoretical right price, mostly that is allocated a mark, because most of the students have a challenge in terms of how to compute what? That. And basically by doing that, a candidate secured how many marks? 6 marks. So therefore that is it, that what the examiner was requiring as far as that question for November 2019, question number 5A is concerned. And that is all about the computation of the basic earnings per share. So once we come back in our next session, I want us to discuss on the second type of earnings per share, the diluted earnings per share. We look on how it is computed, why companies are required to compute the diluted earnings per share. And then from there, we look on an illustration question, which is also based on a past paper question. So see you in the next session.
Greetings to you all and welcome to our today's lesson. My name is Nicholas Sikali. Our today's lesson will focus on pivot tables in Excel. Pivot tables are a powerful tool that is used for data analysis in Excel, and it enables you to interact with huge sets of data in a way that you want. So for pivot table, you can be able to summarize huge data set, and come up with some more tables that will be able to make you understand the data that you have better. So in pivot table, you will analyze data interactively, come up with other tables, and be able to make more viable interpretations and decisions from the new tables that will be created from one table, of course, which we'll be having at the initial point. So welcome, and I believe you will enjoy this session. So with me here, I have a huge data set which we'll be using to be able to explore our data table techniques, or our pivot table techniques. You can see with me here, we have the order ID in column A. Order ID in column A, it moves up to all the way to 213. We have the second bit. We have the second bit here, which is product. Different products like carrots, broccoli, banana, orange, all the way. There is category. Of course, they are categorized either into vegetables or fruits. We have amounts that were sold. We have the dates that each one of them was sold. And we have the specific countries that relate to that. So we want to make interpretation from this particular table, you can see. And within a short period of time, if you are to be asked, which country do you think made the most sales? Of course, which country? Is it the United States that made the most sales? Is it Germany? Is it Canada? Is it France? Which country made the most sales? It's very difficult for you to be able to tell that. You can be asked, which product between carrots, broccoli, banana, beans, apple, and all these products here, which one was sold most? And again, you can see it's very, very difficult for you to come up with that particular decision. Which category between vegetables and fruit had the highest amounts of revenues or sales? Again, it becomes very difficult because the data is too huge. Remember, it's ranging from 1 all the way to 213. So it's huge. You can't really tell how much was from apple, how much was from banana, from beans, from orange, from carrots. It's very difficult, and you really, or you can spend the entire day analyzing this data and finding out which product had the highest, which category had the highest, which country had the highest. So it becomes very hectic and very difficult. But with the help of pivot table, you can be able to come up with sub-tables from the main table, from which reading of data becomes very easily. You can come up with the reports at any time, at any point, using the shortest time possible. You can do it in a matter of seconds and come up with a list of products, or a list of countries, or a list of categories that had the highest amount of revenue. So welcome, and I believe this session will provide you with an opportunity to be able to interact with this huge data set and break it down into sub-reports that can be able to help you to make decisions using the shortest time possible. So pivot tables. And for you to be able to access pivot tables, they are inside the insert menu, and you can be able to see pivot table here. So insert menu, and you can be able to see pivot table here. And when you click on it, of course, you can see that you have an opportunity to be able to do it from a table, and you can also be able to do it from an external data source. So it can either be from a table or a range. When you click on from a table or a range, it means you have to select all this. To make your work easier, instead of, again, this is a range now, selecting the range, to make your work easier, you prefer, or personally I prefer, making pivot table from a table and not from a range. From a table and not from a range. That is what I personally prefer. But you can also be able to make it from a range, as we are going to see. Now first, I want us to format our data in form of a table. We want to format this data in form of a table so that it's arranged in form of a table. Of course, we have advantages of formatting data in form of a table. That is, in case you add a new data like 214, the table will automatically be adjusted. So that is very important. So let us format our data in form of a table. That is, you click inside anywhere in your data. Just click inside anywhere here in your data. You click inside anywhere. not outside, but anywhere, just anywhere inside your data. Then go to the home menu. Under the styles group, you can see the styles group here. There are three things: conditional formatting, format as a table, and cell styles. I want us to use format as a table. So our data now will be formatted as a table. You click on the arrow, you pick any style. You can go for any style here. I will go for a style which has some blue, and let me pick that. Now our data, you can see the range has been picked to the end. Nothing has been left out, all the way to 213, all the way to column F. So all the way to F214. F214 has been picked. Click on OK, and now our data has been formatted in form of a table. Now this is a table now, and you can see it even has the filters. You can be able to filter things out and do that. Now that is formatting data as a table. The importance of formatting data as a table is that if you are adding, let's say 214, and you have some orange, you can see that the data gets updated automatically. If you go to 215 here, the table gets updated. It keeps increasing to include 214, 215. The range keeps increasing automatically. So that is the beauty of formatting your data as a table. We will use 213 as we had there before. Remember, you can change the styles if you want by just clicking anywhere inside. Then you can change to any other style. If you prefer any other style here, you can still be able to change your data into variety of styles that are provided in Excel. Once you've done your first step of formatting your data as a table, which is not mandatory, by the way, it's not mandatory that when doing pivot tables, you format your data as a table, though it's highly recommended. The second step is that now you go to insert and pivot table. Insert, then pivot table. So I'll click on pivot table, then we will click on from table stroke range, there. Then you can see we picked table 1, so no need of selecting anything. Table 1, and that is the table or range. Already it's table 1. Choose where you want the pivot table to be placed. Where do you want it to be placed? Is it new worksheet, existing worksheet, or where? We want it to go to a new worksheet. Then you just click on OK, and you will have that. So what we have here is sheet 1. Remember this pivot table here, the data that we had initially, but a new worksheet has been added here, known as sheet 1. So we are on sheet 1. So we have pivot table, which we have here, then we have sheet 1. So I'm going to start with certain things that you see here. This is where our report will be placed. Our pivot table report will be placed here. But we have pivot table fields on this particular side. You can see choose fields to add it to the report, and no need for using that. There is also these particular fields here. You can see order ID, which was the first one here. You can see the order ID. We move back to category. There was category there. There is amount, there is date, there is country, and so many things. You can be able to go to more tables if you want. Now there is dragging the fields above between the areas below. There is filter, there is column, there is row, and there is values. You can see how that looks like. Now we want to, assuming that you want your category or your product is to be dropped on columns. Look at what happens. If you want your product to be dropped in columns, that is what happens. Let us unpick. I want to drop products in rows. And this will come here that way. So products in rows. You can see products in rows, and our report is building up. Then I want to see these products. What are the values attached to them? So amount into values. If you take amounts to columns, that is what happens, but I don't want my work to look like that. So amount to values, and that is what you will see there. I want to remove the other one and take amount to values, and you come up with that. So this becomes very easy. And actually, within seconds, you can be able to see that Apple had an amount of let me input columns so that we can clearly see that way. So Apple sold 191, 257. Banana, you can see, sold 340, 295, 557, 281, 142, in that order. Within a very short period of time, you can be able to tell and retrieve such a small report from what you have there. You can do a lot. Assuming that you want country, you can even drop country to columns, if that is what you want. If it looks so bad, you can just drop these to rows. That is how it will look like. Now look at that report, it has changed. If you take country to rows, this is what you see. And it gives you apple in specific countries, banana in specific countries, beans in specific countries. So if you want to undo country, of course you just remove the country and you remain with that. So I just removed the country from the other side. What if you want the country to be in values? That is what will look like. Apple count of countries, and we can be able to see that. So I will remove country and remain with this small report there. Category, if you want to bring in category and take it to either columns, you can see the category. I'll undo. You can take category to products and you can see what happens. And category inside products. So I'll undo category and remain with this small report. I'll save that report. Of course, I'll close this and now save this report to analysis of products. This is products and amount. Product and amount. So that is a report showing you the product and amount there. I can give this a color. Product and amount. This one I can also give it a color red on the other side. So we have, of course, let me move this before product and amount. No, not creating copy so that it's the first one. So we have pivot table followed by product and amount and all that. Now from this huge data set, which will take a day for you to analyze the products and the amount of sales that they made, we've used a very short period of time to get product and amount here. So let us do another one. Again, pivot table, insert pivot table, then here, then same range, then okay. We want to do another one. What if it is category? So you take category and put it inside rows like that. Which category led? So category against amount or against values. You can see categories against values. And you can see vegetable and also the other one. I will include the zeros and the commas. The category that led was fruits, which was at 693,069. Vegetables followed at 336,665. So I will rename to category and amount. So that is category and amount. Then I will give it a color from which we can move it to end. So we are moving it to end. Then okay. So now it is at the end. You can see category and amount. Again, from this data set, we want to do another pivot table, which is a bit more complicated, including so many things. So pivot table, then okay. And here, we want to start with the ID. The IDs will be under filters, or maybe no. I want to start with category under rows. Not necessarily category, but products. Let products be under rows. Under rows. Then category also that way. No, let me start again. So I'll start with category under rows. Then products also under rows. So you can see category, then products also under rows. Then we have the country, which we can put under columns. country under columns, then the amount can also be seen under values. Now look at that. A very another dynamic of how a pivot table can look like. Like fruits, total of 91 to, that is 91, 9, 12, and what? Let me put the 0 so that it can clearly be seen. In the home menu, put the commas and you reduce the zeros. Fruit in Australia amounted to 91, in Canada amounted to 82, in France amounted to this. Apple, again, the same breakdown of things in every other thing. So these are more complicated kind of reports that you can be able to make from that huge data set, where we had product, category, amount, and country. So this one can also be able to be saved here. And this will be, it has a, I can give it a name, analysis 1, analysis 1, maybe analysis 1 there. Then I can move it to end. Let us move it to end. So move or copy, move to end, then OK. Then tab color, that way, in tab color. Tab color, one that is more, yeah, that is fine. So this analysis 1, where you can be able to see categories like fruits and the countries, different products, countries and the total, a category of vegetable and different countries, beans, of course, under vegetable we have this, and also with various items there. Now we have analysis 1, we have category and amount, we have product and amount, then we have our main data that is from the pivot table which we have here. The last one that I want us to try is that this can also be even more complicated, and one can come up with something that it's even hard to read. Like we have that, then we have it goes to columns, you can see there. Then we have countries, which also goes here. That one looks bad, so country, I'll take it to rows. Look at that. Then amount, I'll take it to values. So this is what we have now. A very other complicated, though it's understandable, like fruits, vegetable, and grand total on the other side. You can select and give it some, select home, then the zeros after the commas here, we reduce the zeros to what we have there. Now look at the first one. Fruits, there is apple and vegetable, of course, from different countries and all that. Now this is another set of pivot table, which we can call analysis 2. So this one can be analysis 2, like that. Then move this to end, move this to end, and of course it's at the end there. Can give it a color, and this can be that one of a color. Now look at that. We started with the data from which making a decision was very difficult. Somebody would ask you a simple question and one cannot even tell, like, which category between fruits and vegetable had the highest. You will take so much time, but with pivot table you can quickly get here. Now which product had the highest? With pivot table you can be able to see that it is our bananas that took the highest. You can see category and amount, this analysis 1, this analysis 2, and so many things. One can do a lot. For instance, you can create another pivot table and say, okay, and just do these things randomly. Like you want this to come here, you want this to come here, and no, I'll do away with that. You want this to come here. You want the countries to come under category. You also want the countries to go under columns, and that one looks bad. You want the amount to come here. This is another set of pivot table that you can come up with. So this one can be given analysis 3. So you can do a lot of analysis from your pivot tables, comma, then we will reduce that to that point. So this will be analysis 3 of pivot table. Again, this can be interpreted. We have fruits and other fruits. You can see countries, and this one is giving you different items, vegetables, and also different items here. So this will be analysis 3. After changing the color, we'll give it analysis 3. Analysis 3 in that order, and clearly it's now taking shape. We'll move this to end, so move or copy so that it's taken to the end, and okay, this can always be closed and we remain with our data here. Now we have the first one, which was pivot table, our data which we formatted as a table using this option. We did a simple one here, that is product and amount. There is category and amount. There is analysis 1, this analysis 2, and this analysis 3 of doing this pivot table. And remember, pivot tables usually go as well alongside the pivot charts, which is also done the same way. So up to that point, I believe that you should be in a position to do pivot tables. The file that we used will be shared below the video description so that you can be able to do your practice. You can be able to do practice on your own and come up with various summaries from a huge data set. That means you work with your data interactively and come up with so many other reports from the main table, which can be used for various decision-making ideas or analysis of data to come up with different views. Bye for now, and see you again.
Learner, welcome to our lesson today in Human Resource Management on the Manifested Publishers Learning Platform. I'm delighted to welcome you to the lesson of today. And our lesson of today is impact of performance management to human resource management. So it should be noted that performance management assists an organization to monitor. Performance management assists an organization to monitor employee performance and provide indicators where employees require support, and areas that require interventions, So for learners, performance management is critical. And if the performance of workers is not monitored, an organization may not have information regarding the areas where workers may want to be assisted, and that hence the importance and the value of performance management, which is expected to monitor, is expected to obtain feedback, is expected to recommend intervention measures, with a key element of ensuring that performance is sustained or is exceeded in relation to individual and organizational objectives. So we want to have a look at the impact of performance management to human resources. The information that is received from performance management, how does it help in making prudent decisions in relation to human resource, which is arguably the most important asset any organization can have. So in one of the areas in which performance management may have an impact is that when feedback is obtained, this can help in reviewing employee performance to enable employees perform better. Review employee performance for enhanced results. So when performance management information is obtained, that performance management information may help in reviewing the performance of a given employee, within a given organization, so that if the employee has performed at the level of, for example, 55%, then that employee could be subjected to intervention measures that can help enhance the performance of that particular employee, maybe to a level of 60 or maybe 65. And then agreement on key performance indicators is also another aspect. Agreement on key performance indicators. Agreement on key performance indicators. So every job has got sometimes what are referred to as KPIs. KPIs, key performance indicators. So the performance management process will help particular cadres of employees, particular positions within an organization agree on key performance indicators that can be used in the process of evaluating jobs, or agreeing on what could be the indicators that can be used in the performance management process, and focusing that to that particular organization. Then assisting job holders. Performance management can also help in assisting job holders understand their roles and expectations. Understand their roles and expectations. So the performance management process can assist job holders to understand their roles and expectations in the performance within the given working environment, and also the role they are expected to play to ensure that the organization performs well. Then the performance management process can also be useful in number 4, assisting or you can say helping employees identify their training needs. So where you have an effective performance management process, then that performance management process can help employees be able to identify their training needs. Because if a worker was supposed, as the example we have just given, if a worker was expected to perform at say 80%, and that worker performs at 55%, so that could be an indicator that there is something the job holder or the worker is supposed to be doing, and maybe due to lack of skills, that worker is not able to do whatever is supposed to be done. So that can help an employee identify training needs, which can be mitigated by appropriate training. Then there is also the element of obtaining feedback. So we said here, Lana, in one of our lessons that there needs to be what is called a feedback loop. So in the process of performance management, you have the supervisor, you have the employee. So there has to be a communication from supervisor to employee, from employee to supervisor. So that performance process becomes effective if the supervisor is communicating to the employee is communicating to the supervisor. So you have a loop that basically helps these particular levels to communicate. And if that communication is effective, the performance management process helps in improving human resources in terms of communication, in terms of how they basically work within that particular setting. Then number 6, addressing challenges of substandard performance. So through the performance management process, it is also important that an organization can be able to address challenges associated with substandard performance. This may, for example, be in terms of, say, quality expectations, maybe, for example, in terms of time commitments. You are supposed to have a department or an employee deliver particular items maybe to the customer by a particular time, particular quality, maybe particular quantity, and so on. So these are things which can come out very clearly in the performance appraisal process. And when it comes out in the performance appraisal process, these issues can be addressed within that particular organization. There is also the element of 7, making decisions based on outcomes of performance evaluation. Or management. Now, for example, if you have a performance management process, and at the end of the year, employees have, for example, met targets, then it is possible that if at the beginning of the year it was agreed that once targets have been met, organizations, for example, should provide maybe a bonus or what you call performance related pay, or other rewards could be given based on the performance management process. So it means where workers have now performed and the performance management cycle has come to an end, then certain decisions can be based on the outcome of this particular this particular performance management outcomes, and that may have an impact on employees in that particular organization. So that is also one of the ways through which performance management can impact human resources in a given organization. Then there is also the element of maintenance of equity. Maintenance of equity. So if you have a performance management process that is effective, then it is also important that an organization can use this to maintain a balance when it comes to work and benefits, for example, so that if you are talking about equity, then you may want to give rewards maybe to a team. So if you have what you call team rewards, so these rewards are given to teams, so workers cannot say they have been segregated or there is an element of bias in terms of that particular environment and so on. Then this can also, information can also help in assist in design of job design. So the way jobs are linked, So if you have an effective performance management process, then the impact would be the way jobs are designed in a given organization may be influenced by the outcomes of the performance management process, so that jobs are designed in a way that can be able to help an organization achieve its short-term and its long-term, for example, objectives. And then there is also the element of employee involvement. And engagement. Employee involvement and engagement. So if you look at it, dear learner, critically, what happens in a performance management process, this is a collaborative process, okay? Collaborative process. So why do we say collaborative? You are agreeing on, for example, targets. You are agreeing on targets. And who are the people agreeing on targets? The people agreeing on targets are employees, employees on one side. These employees could be members of teams, so there'll be teams. These employees could be members of departments. Then you will also have supervisors. You also have management. Okay, you also have management. So these employees, teams, supervisors, management have to collaborate when it comes to the performance management process, which means employees have to be involved and they have to be engaged so that organizational and individual goals are achieved. For example, an organization wants to be productive. So if an organization wants to be productive, so that organization can be able to achieve its productivity through the workers. Workers also want to get a bonus. Workers also want to get a promotion. Workers want to get paid. So that then becomes a collaborative process, and it has an impact on how workers and managers work within a given setting. So Lana, today we have concentrated on impact of performance management to human resources, and we have said at the beginning of our lesson today that performance management is expected to assist an organization to monitor employee performance, provide indicators where employees require support, and areas that require interventions. And we have gone ahead and looked at the impact of performance management to human resources, and we have indicated that, one, performance management helps an organization to review employee performance for enhanced results. Number two, agreement on key performance indicators, KPIs. Number three, assisting job holders understand their roles and expectations in the production or maybe work environment. Number four, help employees identify their training needs, of course also their development needs. Number five, obtain feedback through the feedback loops between supervisors and employees. Number six, address challenges of substandard performance in terms of quality, time, quantity, and so on. Number seven, make decisions based on outcomes of performance management like evaluation, so that employees who have met targets can, for example, be given bonus, performance-related pay, and other rewards or incentives. Number eight, maintenance of equity or a balance, where, for example, an organization can provide team rewards. Number nine, assist in design of jobs, the way jobs are linked within an organization. And number 10, employee involvement and engagement. These ones are very key to ensure productivity in an organization where the performance management process is collaborative. So you have number 10, employee involvement and engagement can be enhanced through an effective performance management process that can have an impact on human resource management. So Lana, before we finish our lesson, you have your assignment for today that you need to work on to be able to gain more in terms of knowledge. So the assignment is describe the impact of performance management on human resources in an organization. So this is your assignment, dear learner. Describe the impact of performance management, performance management. Describe the impact of performance management on human resources in an organization. So that is your assignment for our lesson today, which was impact of performance management to human resources. Thank you very much. Welcome to our lesson in human resource management. We are continuing with our topics in the lessons that we are taking under the Manifested Publishers learning platform. And in today's lesson, we are going to look at team performance evaluation. We are going to look at team performance evaluation, which is an interesting area in performance management. And the reason why we are interested in team evaluation, performance evaluation, is because oftentimes in the working environment, sections are created, departments are created, units are created, and they are subjected to work, and it is important to know how they are performing for purposes of ensuring they are on track. Hence the importance of today's lesson, which is team performance evaluation. Now, team performance evaluation is the identification of the strengths, and the weaknesses of each member in a team for assuring the productivity of employees and teams in an organization. So the way the term suggests, you are interested in looking at the strengths of each member. You are looking at the weaknesses that may be there for purposes of ensuring that each member who may have a weakness, that weakness can be mitigated, or intervention measures can be taken to ensure that the aggregate performance of the team is as per expectations, or it exceeds expectations. So that's why, dear learner, we are saying team performance evaluation is the identification of the strengths and weaknesses of each member in a team for assuring the productivity of employees and teams in an organization. We want to look at ways of evaluating the success of teams. So what are some of the ways through which as a manager, as a supervisor, or an organization can be able to find out or evaluate the performance of the team? So there are various things which can be done. So one of the things that can be done to evaluate the success of teams is to assess the level of involvement. So one, assess the level of involvement of each team member. So if you are looking at a team, and a team is made up of various members, so you may want to look at now each member, how involved are these members in the activities of this particular team. So if you find the level of involvement for each member of this team is high, then that team is likely to perform well or must have performed well. And if the level of involvement of the members is low, then in evaluating the success of that particular team, then it may be on the lower side. Then you may also want to look at quantifying the success achieved. Quantifying the success achieved. Now, let us take, for instance, you have seen in the ministry, for example, responsible for lands, they set out and say, as a department or as a ministry or as a section, they want to issue, for example, 1,000 title deeds, maybe in a week. So if you look at it that way, and the target for the week was 1,000, so if at the end of the week they have issued 600, then it means as a department they are falling short of 400. And that way it is possible to evaluate the success of that team against that particular quantification that has been done in relation to that particular target. And then an organization must also be able to establish a clear baseline. Number 3, establish a clear baseline against which a team has to be evaluated. A clear baseline against which a team has to be evaluated. So what you are saying, dear learner, is that if you are going to evaluate a team, before that team is given the work they are supposed to do, a clear baseline has to be indicated that this team, at the end of this particular evaluation period, they will be evaluated based on a particular baseline, and those targets are the ones that will be used to evaluate whether that team has succeeded or not. Then comparing teams, so the fourth way of evaluating the performance, comparing team performance with other teams, comparing team performance with other teams. So you may have, for example, in an organization, if the organization is an automobile company that is, for example, selling vehicles, then you have the same categories of vehicles. You have one organization maybe located in Nairobi, you have another organization located in Mombasa, another one in Kisumu. So you are able to say Team A, for example, is in Mombasa, Team B is in Nairobi, Team C is in Kisumu. So you may want to look at a given period of time and now compare. The team which was Team A, how many vehicles have they sold? Team B, how many vehicles have they sold? So comparing team performance with other teams can be able to help you evaluate and compare that Team A compared to Team C, this is how they fared on. Team B compared to Team A, this is how they fared on. So that comparison helps in ensuring that an organization can be able to evaluate the success of a team or a department or a section. Then taking note of any positive an organization has also to take, taking note of any positive or negative outliers, negative, positive or negative outliers in a team. So if you have a team and some of the team members are performing very well, some of the team members are performing very poorly, so these outliers may have an effect in terms of the overall performance. So an organization may want to evaluate the outliers and be able to now say if somebody is performing very poorly, then what could be the reason for that particular performance in terms of that particular team, and maybe an intervention measure can also be taken. So that is another measure that can be taken, or another way of evaluating the success of a given team and so on. Then the level of realization of set objectives, level of realization of set objectives, a level of realization of set objectives. So if particular objectives have been set, or particular goals, for example, have been set, you have objectives, you have goals, for example. So the level of realization of set objectives that a team is exposed to can also be used to evaluate the success of a team. So if an organization has several groups and one group consistently meets and exceeds objectives, then that particular group or team can be said to be meeting the standards that have been set, to be meeting the level of expectation or exceeding what that organization has set out. So dear learner, this could be some of the ways of evaluating the success of teams. And when you are now doing this evaluation of the success of teams, so what are some of the methods of evaluating team performance? Methods of evaluating team performance, which methods can be used to assist in evaluating team performance. Methods of evaluating team performance. So what are some of the methods that an organization may use to evaluate team performance? So one, you may want to look at a different range of methods. So you have what you call graphic rating scales. Graphic rating scales. Graphic rating scales. Graphic rating scales. So here, the way the word suggests, you may want to look at scales, and these scales could be, for example, from the range of, let's say, 5 to 1, where 5 is the highest, 1 is the lowest. Then you may have attributes or attitudes that you want now to be able to use for this particular rating, where you may want to look at maybe the team members themselves and now try to rate the performance of those team members based now on issues like, say, competency, skills, and maybe knowledge. So once you now do the rating, then you can get the graphic rating scales for one group, get the graphic rating scales for another group, and with that, you can now be able to evaluate the various groups or the various teams in a given organization based on those particular graphic rating scales. So depending on the needs of the organization and the kind of team and the kind of activities the team is engaged in, graphic rating scales can be used as one of the methods. Then you have what you call narrative essay. Narrative essay. Narrative essay. So in this process, what the supervisor or manager for the team does, or those evaluating a team do, they look at what the team has done, they look at the group members, they look at the records and so on, they look at their performance and write an essay or a statement in their own words based on what they have understood, and evaluate the team performance in relation to how they understand it based on their experience. So the people doing the rating are able to use their own language. Then you have what you call forced distribution. Forced distribution method. Forced distribution method. So this method of evaluating performance, workers in a group are distributed based on a predetermined curve. So you have a predetermined curve, and in this predetermined curve, you are looking at 20% of the workers, you are looking at 70% of the workers, and you are looking at 10% of the members of that group. So regardless of the number of members, but 20% of the members, it is predetermined. They will be in a particular category of performance. 70% will be average, and 10% will be at the lowest. So it is presumed that if you have a group, 20% of those group members, if you have a group, 20% of those group members will be at the top. 10% of those group members will be average, and 10% of the group members will be at the lower rank. So what this means, dear learner, is that if you have, say, 10 employees, so it means 2 workers must be rated as top. Then 7 workers must be rated as average, and 10 workers must be rated at the lower level. So that is a forced distribution. It has its advantages, it has its challenges, but this one has been suggested as a method of evaluating team performance. So if you also have 10 groups, then 2 groups must be forced to be rated at top, 7 groups must be rated as being average, and 10, if you have 10 in total, so 2 groups top, 7 groups average, and 1 group should be rated at the lower level, and so on. So that is a forced distribution method that can also be used to evaluate the performance of a team. Then you also have what you call, number 4, a peer evaluation. Peer evaluation. So in peer evaluation, the way the word suggests, members within the group can be able to be asked to do a rating or an evaluation of how the team has performed. And the good thing with this peer evaluation, it helps in providing a dimension that may not be very open or very clear, maybe from the supervision or management. So peer evaluation can also be one of the methods that group members can be asked to carry out an evaluation of the team, or maybe another team that they are also working with, and so on. Then you also have what you call management by objectives method. Management by objectives. So this is what is popularly known as MBO, management by objectives. So groups which are concerned with activities that are linked to the organizational objectives can be, for example, evaluated based on the management by objectives method of evaluating performance. So this was suggested by Peter Drucker, and it can be one of the methods that can be used in evaluating team performance. Then you also have what you call 306 use of 360-degree feedback. So sometimes this process is also referred to as multi-stage. This is also referred to as multi-stage evaluation. Multi-stage evaluation. So what this one means, dear learner, what this means, you get feedback from different sources. You may want, for example, to argue if you have certain stakeholders. You have stakeholders who are interested in the team that you are talking about. So stakeholders. So here you can get an evaluation done by employees. The employees who are team members can do that particular evaluation. If it is a group that deals with customers or clients, this group can also be evaluated by clients, or you can say customers. So that group is evaluated by customers. That group can also be evaluated by managers. Managers can be evaluated by supervisors. Okay, so you have employees, you have clients, you have managers, and you can also have this particular feedback from, say, the financial results. Financial results, for example, can also be used in terms of how the group has performed. So you get multiple evaluation sources, and based on what comes out, the group performance is evaluated. So these are some of the methods that can be used in relation to evaluating team performance. So dear learner, these methods can be used in combination, and these methods are normally used based on the type of group, based on the time when the team is performing, and other matters that could be respective or maybe specific to that particular group will dictate an organization can use one of these methods for evaluating team performance, or can use a combination of methods to be able to get different dimensions of that particular group. So today we have been looking at team performance evaluation, learner, and we want just to summarize and wrap up what we have been doing today. And we started by saying that team performance evaluation is the identification of the strengths, weaknesses of each strengths and weaknesses of each member in a team for assuring the productivity of employees and teams in an organization. Then we have gone ahead, learner, and looked at ways of evaluating the success of teams, and we have indicated that one, teams may be evaluated by assessing, number one, assessing the level of involvement of each team member. Number two, quantifying the success achieved. Number three, establishing a clear baseline against which a team has to be evaluated. Then number four, comparing team performance with other teams. Then number five, taking note of any positive or negative outliers in a team. And then number six, level of realization of set objectives or goals can also be one way of evaluating the success of a team. Then we have gone ahead, Lana, and looked at the methods of evaluating team performance, and we have said there are various methods which can be used to evaluate team performance, and one of them is graphic rating scales can be used. And in graphic rating scales, you may have scales of ranging, say, from 5 to 1, where 5 is the highest, 1 is the lowest, and each of these can have attributes that may, for example, be evaluated. You may also want to look at, say, the competencies. Competency, maybe skill, and maybe performance of that particular group. And then the rating is done based on that scale of 5 to 1. Then we have also said that another method of evaluating team performance is a narrative essay. And this narrative essay can be written by a supervisor or a manager or any other person evaluating the team by looking at how the team has performed and other key performance indicators of the team performance, and now doing a statement or a narrative, regarding how the team has performed. Then we have also looked at the third method of evaluating team performance, which we have said could be forced distribution. And in forced distribution, we have said that the way a team is evaluated, it must comply with that particular distribution of 20% as top performers, 70% of the group or the team as average performance, and so on. And then 10% of the group must be at the lower rank. So that is how using forced distribution method can be able to be used to evaluate team performance. That is number three. Then number four, peer evaluation, where here workers or colleagues can be used to be able to carry out evaluation of a group. So management by objectives can also be used as one of the methods of evaluating performance, which was propounded by Peter Drucker. And in management by objectives, objectives are set at the beginning, they are agreed, and an evaluation is done at the end to compare what was agreed and what has been performed. So here, the supervisor or the manager and the teams work together to be able to evaluate that team performance. Then when it comes to use of 360-degree system, that's the sixth method that can be used. This system is also referred to as multi-stage evaluation, where the stakeholders involved in that particular system, like employees, clients or customers, managers, supervisors, and also the financial results can be used to be able to evaluate the performance of a team. So Lana, this has been our lesson on team performance within performance management context of human resource management. And before we finish our lesson, I want to give you an assignment. So your assignment for today's class or today's lesson would be discuss the methods that may be used. Discuss the methods that may be used to evaluate. Discuss the methods that may be used to evaluate team performance. discuss the methods that may be used to evaluate team performance. So, Lana, that is your assignment. Thank you very much for being attentive in the lesson. Lana, welcome to our lesson, Human Resource Management, on the platform of Manifested Publishers platform. And now, today's lesson, we are looking at performance management, and we are looking at challenges of performance management. And these challenges may be looked at also as difficulties, challenges, or you can say difficulties, difficulties of performance management. Performance management. We want to discuss a few of the difficulties or the challenges that may be associated with the performance management process. And as we have been indicating in our previous lessons, when it comes to the process of performance management, you have workers on one side, you have employees on the other side, and you are looking at the productivity or production of employees, production of also supervisors. And one of the challenges that may be encountered in the process of performance management is the lack of integration, integration of the performance management with other organizational processes. So you have a situation where the performance management process is supposed to be, for example, undertaken within an organization for a given period of time, maybe 1 year. But that performance management process or performance management function or activity is not integrated with other organizational processes. So that creates some kind of a conflict, and that becomes a challenge because for effective performance management, then it has to be integrated within the wider organizational activities and so on. Then sometimes another problem that could be encountered in performance management is the challenge of lack of effective leadership and commitment of senior management. So senior management may commission, for example, the process of performance management to be undertaken in an organization. But where the top management does not give their commitment, that they don't support this particular process by providing the required leadership, then that becomes a very difficult situation to overcome, because as you come down within the organization, other lower organizational levels may not take this effectively, especially if the top management of that particular organization has not supported the process of performance management effectively. Then sometimes wrong design of performance management and performance management tools. So the tools or the instruments that are being used instruments that are being used for the performance management process are not designed appropriately. You may go to one organization and you find the same tool that is being used by production department is the same tool that is being used by management department, the same tool that is being used by a marketing department. So you have marketing, you have production, you have finance, and you have HR, for example. So if you are using the same tool to evaluate different functions, then the wrong design of performance management and performance management system and performance management tools, that creates a problem within a given organization, and that could compromise the results that are likely to be achieved from this particular process, and that is another difficulty or a challenge of performance management. Then sometimes there is the element of the incompetence of managers, supervisors, or employees regarding performance management. For example, Lana, a supervisor is supposed to agree with the employee on the targets to be achieved at the beginning of the year or at the beginning of the evaluation period. But due to incompetence, these targets are not set. These targets are not fixed. The supervisor does not ask, the employee is not aware, or they don't fix them appropriately or properly, and so on. Then that may compromise again the process of performance management. So incompetence of managers, supervisors regarding the performance management that is supposed to be conducted within an organization may sometimes be a difficulty or a bottleneck that may compromise the process of performance management. Then sometimes performance management may be, you may be implementing a performance management process, but changes take place. So when an organization failure to take into consideration, changes that may be taking place in an organization. So, dear learner, they say that change is the only constant, and an organization may experience some changes that were not foreseen. So when a performance management system had been set up for that particular period of time, then the performance management process, the performance management must take into consideration the changes. But where an organization does not take into consideration changes that could be taking place when the performance management process is being implemented, then that one becomes a big challenge for that performance management process within that particular organization. Then inability to conduct quarterly reviews of performance management. So what you are saying, Lana, you may have an organization that is doing its performance management for a period of 12 months. But 12 months is a long time in relation to organizational activities. So if you start in January and you'll do your evaluation of what you have done the other January, so the 12 months elapse. So it is imperative that for you to keep tabs of what is happening, maybe after every, let's say, 4 months or 3 months, an evaluation is done to monitor whether you are on course and so on. So inability to conduct quarterly reviews of performance management or half-yearly reviews of the performance management in an organization creates a challenge within an organizational setting, and that could also lead to bottlenecks or difficulties in performance management processes and so on. Then not giving teams, not giving or providing teams with clear goals or objectives. So you have teams, you have individuals, you have groups, for example, but these groups are not given clear objectives that they are supposed to be able to achieve, clear targets that they are supposed to be achieved, that they are supposed to achieve in a performance management, for example, cycle. So when that is now not done, it becomes very difficult for you to achieve consistent, for example, results, and that becomes, again, one of the challenges in relation to the process of performance management. So again, lack of effective communication, a lack of effective communication regarding expectations. So lack of effective communication regarding expectations, that is also another challenge that may accrue or may be encountered by an organization in the process of performance management. And then also number 9, utilization of paper processes, performance management processes that are unnecessarily slow. So basically you can imagine if you have an organization with, say, 2,000 employees, and you are going to agree on targets, you are going to fill forms, and these processes are largely manual. So what you are saying, these processes are largely manual processes. So these processes may be time consuming. These processes will be time consuming, slow, and manual. So that again becomes a challenge or a difficulty in the in performance management in any given organization. So that again is a bottleneck that an organization has to be able to address in order to ensure that this process is effective. Then, dear learner, challenges that may again accrue because performance management is conducted in the context of business. So the other challenge that could be encountered will be lack of authority for employees to perform their tasks, their work. So workers are given work to do, but they are not given commensurate authority. So that again becomes a challenge. Workers are waiting, there is no authority, there is no clear communication, so they'll be waiting and wasting time. So these, dear learner, could be some of the main problems, the main challenges, the main bottlenecks that may be encountered by an organization or by an entity that intends to conduct performance management. So we can go through them again in a form of summary. We have looked at challenges or difficulties or bottlenecks in performance management, dear learner, and we have indicated that, number 1, lack of integration of the performance management with other organizational processes is one of the challenges. Challenge number 2, lack of effective leadership and commitment of supervisors in an organization is also a challenge to performance management. Number 3, wrong design of performance management system wrong design of a performance management system and performance management tools. So you are using a wrong design, you are using wrong tools or instruments to do the evaluation of performance management. So that is a bottleneck or a difficulty in performance management. Number 4, incompetence of managers, supervisors, or employees regarding performance management. They don't have a clear understanding or grounding in terms of what is supposed to be done, what is expected. Number 5, failure to take into consideration changes that may be taking place in an organization. Number 6, inability to conduct quarterly reviews of performance management. Number 7, not giving or providing teams with clear goals or objectives. Number 8, lack of effective communication regarding expectations. Number 9, utilization of paper performance management processes that are unnecessarily slow, time-consuming, and manual. That is another challenge. Number 10, lack of authority for employees to perform their work. So, dear learner, these ones are some of the challenges or bottlenecks that may be encountered by an organization that is conducting or is aspiring to conduct performance management. So, dear learner, your assignment for today is based now on the challenges of performance management that we have looked at. Your assignment is assess the measures that may be taken assess the measures that may be taken to overcome the challenges encountered in performance management. So, dear learner, this is your assignment. Assess the measures that may be taken to overcome the challenges encountered in performance management. So, dear learner, I want to thank you very much for being attentive in our lesson today, which was challenges of performance management. Thank you.
Hi candidate, welcome to another session of manifested online classes. So we are still soldiering on with the syllabus coverage, and in this session I want us to look on IPSAS 9, which governs or basically which establishes now the principles for recognizing revenue by the public sector entities which are involved in what you refer as the exchange transactions. So when talk about exchange transactions, these are those particular transactions undertaken by public sector entities, whereby a public sector entity will receive some consideration or basically some price, and the public sector entity is expected to give some services to transfer some goods equivalent to the consideration which has been received. And therefore, what IPSAS number 9 does is that it establishes now the principles for recognizing revenue from such transactions, that is exchange transactions, by what we refer as a public sector entity. So therefore, we can say here as our introduction that IPSAS 9 establishes the principles for recognizing revenue from exchange transactions. So any revenue which is received from exchange transactions, how is it supposed to be recognized, or how is it supposed to be accounted for by the public sector entity? Establishes the principles for recognizing revenue from exchange transactions by the public sector entities, the public sector entities, and we can say that the exchange transactions include number one, what we refer as a provision of services, a provision of services whereby a public sector entity is providing services and is getting some consideration in return. That is a good example of an exchange a transaction. Number two is what we refer as the sales of goods. The sales of goods. A public sector entity is selling some goods now to the members of the public and receiving some consideration equivalent to the value of the goods which have been transferred or sold. And also we have what we refer as use of assets by others. So when talk about this particular transaction here, use of asset by others, this whereby a public sector entity owns some assets and it leases out those particular assets to other parties who are expected to use those particular assets for a given period of time and pay some consideration to the public sector entity. So therefore, in terms of how this particular, or in terms of how the revenue from all these particular transactions should be recognized by the public sector entity, then that is governed by this particular standard here, that is IPSAS IPSAS 9. Then from there we can also look on the scope of this particular standard, the scope of IPSAS 9. And generally what we have said is that IPSAS 9 here, this applies to all the public sector entities which are undertaking or which are involved in the exchange transaction. If a public sector entity is providing services to the members of the public and receiving some consideration on the same, is selling some goods to the members of the public, receiving some money or leasing out some asset, so how should it recognize now the revenue from all these particular transactions? So those particular public sector entities which are undertaking or involved in exchange transactions, then they should recognize revenue from such transactions in accordance with these particular standards here. And therefore we can say that it applies to all public sector entities. It applies to all the public sector entities that engage in exchange transactions, including provision of services, sales of goods, and use of asset by others. Use of asset by what? By others. Use of asset by what? By others. So then from there we can look on some few definitions. We can look on definition of a few terms. Definition of terms. So here we have two terms we need to define. Number one, we need to define what is an exchange transaction. That is something we have already mentioned here about an exchange transaction. And also the other term we can define, which is also a key term, is the revenue. So let's start by defining the first term, which is revenue. And basically we say that revenue is what? This is the inflow of resources. Or basically inflow of cash arising from these particular transactions here, like provision of services, like sales of goods, or basically as a result of leasing out some assets. So therefore we can say that this is the inflow of resources, arising from exchange transactions, transactions arising from exchange transactions. So if a public sector entity is selling some goods now to the members of the public, it is providing services to the members of the public, it is raising some of its assets, definitely there is some inflow of what? Resources. There is some cash which is received from such what? Transactions. Then the other term which we need to define is what we refer as the exchange. The exchange transaction. Exchange transaction. What is an exchange transaction? An exchange transaction, in very simple terms, is basically a transaction whereby a public sector entity will do what? Will give some resources to another entity, and the other entity, or basically the other party, give some what? Give some resources which are equal to or equal in value in exchange. So therefore we can say that this is a transaction in which a party give resources to another party and the receiving party gives resources equal in value in exchange. Equal in value in what? In exchange. So for example, what we know is that if, for example, a public sector entity is selling some goods. So let's assume we have a public sector entity here, a public sector entity which is involved in selling some what? Some goods, maybe to the members of the public. So once this particular public sector entity sells those particular goods, then it will receive a price which is equal to the value of those particular goods which have been sold. Now, this is a good example of an exchange transaction, because we are saying is a transaction whereby one party, for example, the public sector entity, will give some resources to another party, is a member of the public, and the member of the public or the receiving party will give a resource, which, for example, can be a price equal in what? In value, in exchange of the resource now which was given by the public sector entity. So therefore, these are some of the terms you must be in a position to do what? To define. You must be in a position to define. Then from there we can proceed and look on the recognition criteria for revenue, or we can just talk of revenue. Recognition criteria. So basically when we talk about revenue recognition criteria, we're talking of the conditions which must be satisfied for revenue from exchange transactions to be recognized. In this case, we can say revenue from exchange transactions should be recognized if these two conditions have been met, or if these two criteria are met. Number one, it is probable that future economic benefits will flow into the entity. For example, a public sector entity has provided certain services, or basically it has sold some goods, and therefore the public sector entity is expecting some money from the services provided, or maybe from the goods now which have been sold. So mean that it is probable some future economic benefit will flow into the entity. Number two, or the other criteria for recognizing revenue, is that revenue can be measured reliably. can be measured reliably. So if those two criteria are met, then we are saying that revenue from exchange transaction must be what? Must be recognized. And then finally, let's look on how the revenue from exchange transaction must be measured. We can look on the measurement of revenue from exchange transactions. Measurement of revenue from exchange transaction. So the revenue from exchange transaction should be recorded in the books of account and also in the financial statement of the public sector entity at the fair value of the consideration which is to be received. So therefore you can say revenue must be measured at fair value of consideration receivable. Fair value of consideration receivable. So as a result of a public sector entity providing some services to the members of the public, or basically selling some goods, so how much consideration is to be received, or how much consideration is to be receivable? So therefore, that is the amount at which that particular revenue from the exchange transaction must be recognized in the books of account and also the financial statement of the public sector entity. So therefore, these are basically some of the provisions of this particular standard here, that is IPSAS IPSAS number 9. Now, before we wind up, we have I have some practice questions I want to give you here for your revision purpose. So those question leads in context of IPSAS 9, which governs recognition of revenue from exchange transactions, describe the following. Number 1, the scope of IPSAS 9. Roman 2, recognition of revenue from exchange transaction. So basically you're required to highlight the criteria which must be met for revenue from exchange transaction to be recognized. And number 3, measurement of revenue from exchange transaction. The revenue from exchange transaction must be recorded in the books of account and also in the financial statement of public sector entity at which value. So that, or those are some of the questions you need to attempt, basically, which will help you in terms of comprehending this particular standard here, which is IPSAS IPSAS 9. So we stop at that particular point. See you in the next session as we look on the other international public accounting standard. Hi candidate, welcome to another session of Manifested Online Classes. So we are still continuing with the topic of public sector accounting, and specifically in this session, I want us to look on IPSAS 23, which is basically one of the international public sector accounting standard applied by the public sector entities, specifically in relation to recognition of revenue from non-exchange transactions. And therefore, the objective of this particular standard here, that is IPSAS 23, is basically to establish the principles of measuring and also recognizing the revenue from non-exchange transactions. So what are non-exchange transactions? Non-exchange transactions include transactions such as receiving taxes by the public sector entities, receiving of donations, and also what we refer as the grant and so on. So how should that particular revenue received in form of taxes, in form of donations, in form of grants be recognized, or basically be measured and recognized by the public sector entity? So first of all, we can say that IPSAS 23 establishes the principles of recognizing and measurement, of revenue from non-exchange transactions and exchange transactions, including what we refer as the taxes. We also have what we refer as the donations, we have what we refer as the grants, what we refer as the transfers, transfers etc. For example, when we talk about money which is transferred by the national government to the county governments, that money we can refer to it as a transfer. The national government transfer money to the county government without receiving anything in return. That is an exchange what transaction between the national government and the county what government. So then we can also proceed and look on the scope of this particular standard here. The scope of IPSAS 23. IPSAS 23. And for this particular standard here, we have said it applies to all the public sector entities which receives now exchange from non-exchange what? Transactions. For example, any entity receiving things like donations, receiving taxes, receiving grants, receiving transfers, and so on. So these particular standards apply to such entities. So we can say IPSAS 23 applies to all public sector entities, entities receiving revenue from non-exchange transactions, non-exchange what? Transactions, non-exchange transactions, including taxes, donations. We also have subsidies, and grants and other transfers transfer. Any public sector entity which is receiving taxes or basically collecting taxes from the members of the public, receiving donations, subsidies, the grants and other transfers, then it should account for that money which is received in form of taxes, donations and so on in accordance with what? In accordance with IPSAS 23. Then we can look on definition of few terms. Definition of a few terms. So the first term we need to define here is non-exchange transaction. Non-exchange transaction. Now, an exchange transaction, basically this is a transaction whereby one party will do what? Will give some resources, or in other terms will receive, will transfer. That is, will give or transfer some resources without receiving resources from the receiving party having an equivalent value in exchange. For example, as a member of the public, you pay taxes to the government, but it's not obvious that you're going to receive services from the government equivalent to the taxes you have paid. That is now an exchange what? A transaction. Another good example of an exchange transaction is whereby the national government will transfer money to the county government, and it is obvious that the national government is not receiving some services or even some goods now from the county government as a result of the money which has been what? Transferred. All those are good examples of what? The non-exchange what? A transaction. So therefore, we can say that this is a transaction, in which one party receives value without directly giving something of equal value in exchange, in what? In exchange. And in this case, I've given a good example of this, e.g. payment of a tax. Payment of a tax. So basically I've said, as a member of the public, once you pay tax to the government, it is obvious that the government will not provide services to you equivalent to the amount of tax you have paid. So that transaction between you as a member of the public and the government, whereby you pay tax to the government, purely this is an exchange transaction. So the other term we may also need to define here is the term taxes. So what are taxes? Taxes, basically we know that these are compulsory levies which are imposed on the members of the public and companies by the government, for the government to be able to raise money to provide, or basically to do what? To pay for the public expenditures. To pay for the public what? Expenditure. So we can say that this is the compulsory levies imposed by the government, to who? To individuals. In this case, individuals, here we can talk of the citizens, and companies to do what? To fund the public expenditure, So basically the public expenditure, these are those particular expenditures which are incurred by the government. Like we know the government has to do what? To provide security to us. It has to employ some security guys. The government will have to pay those security guys. The government also cater for what? For other public what? Expenditures, like maybe constructing public roads and so on. So therefore, as a result of that, the government has to do what? To levy taxes. To be able to fund those particular public expenditures. So that is the second term which you must be in a position to define. The other term, number three, is something called the transfer. Now, even before we define this, remember I've said a transfer is, for example, where the national government will transfer money either to public schools, to county government. For those public schools, the county government to provide what? Some services to the members of the public. So once the national government transfer that money to the county government, to the national schools and so on, or to the public schools, the government do not receive anything in return of the money transferred. So that is a good example of what refers as a transfer. So we say this is a voluntary all compulsory transfer, transfer of resources by one party to another, without receiving goods or services of equal value. So therefore, those are some of the terms which you must be in a position to define in accordance with that particular standard. So then from there we can look on the revenue recognition criteria. So basically these are those criteria which must be met for revenue from non-exchange transactions to be what? To be recognized. In this case, we have two criteria for recognizing this revenue from non-exchange transaction. Number one is that there must be inflow of resources. Inflow of resources. For instance, when maybe the national government or even the county government receive a donation, receive some grant, then that should be recognized as what? As a revenue, because the cash has been received. There is inflow of what? Of resources into that particular public sector entity. And number two, we talk of absence of direct exchange transaction, absence of direct exchange transaction. So basically, when we talk about absence of direct exchange transaction, it means that the public sector entity is just receiving resources, is just receiving money, but it is not expected to do what? To provide some services, to transfer some goods in exchange of cash which has been received, or in exchange of the service resources which have been what? Received. So those are the two criteria which must be met for revenue from non-exchange transactions to be recognized. Finally, we can look on the measurement of revenue from non-exchange transaction. And the revenue from non-exchange transaction, this one should be measured, or in other terms, it should be recorded in the books of account at the fair value of consideration receivable. So we can say it is recognized, or in other terms, it is measured at the fair value of consideration received, or consideration which is receivable. Which is what? Receivable. So therefore, that's how that particular revenue from an exchange transaction should be what? Should be measured. So therefore, those are basically some of the issues you need to know as far as this particular standard, that is IPSAS 23, is concerned. So before we wind up, there is an assignment I want to give here, coming from this paper here, April 2022. Specifically, this was a question number 1A, and I can read the question. It reads: International Public Sector Accounting Standard IPSAS 23, revenue from non-exchange transactions, which include taxes and transfer, prescribes the requirement of financial reporting for revenue arising from non-exchange transaction other than non-exchange transactions that give rise to an entity's combination. Required. In context of IPSAS 23, describe the following. Number one, the measurement and recognition of revenue from non-exchange transaction. Number two, measurement of asset on initial recognition. And three, condition for recognition of a present obligation as a liability. So, and the examiner, as far as those three questions are concerned, had given six, or actually a total of 8 marks. So therefore, what you need to do, make sure you attempt that particular assignment. And equally, I also encourage my students to get this particular revision kit here. It is updated to the most recent sitting. So get this one. Basically, you'll be able to get the solution for all this particular assignment I'm giving. So all the solutions are at the end of that particular revision partner, or that particular revision kit. So that is the end of that particular session. So see you in the next session as we look on the other standard. Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 6, which is about public sector accounting standards, or basically international public accounting standards. So in our first class, we defined what are public sector entities. We also defined what is public sector accounting. And also we looked on something to do with IPSAS, International Public Accounting Standards, which we said are standards which are formulated or basically developed by a body known as IPSAS-B, and basically they are applied by public sector entities when they are preparing their financial statement. So in this session, I want us we look on the first IPSAS, which is IPSAS 1, and IPSAS 1 governs the presentation of financial statement by the public sector entities. Remember, first of all, we say that the public sector entities are those particular entities which are accountable to the members of the public, or in other terms, they provide essential services to the members of the public, including the county government, including the central government, including the parastatals, and also the charitable organizations. Now, these particular entities at the end of the year, they are expected or they are required to prepare financial statements by IPSAS 1, and a complete set of those particular financial statements, as we are going to see, comprises of a number of components, actually 6 components. We are going to look on them, and equally from there we proceed and look on the 2 main components. But before we do that, we can say that this particular standard here, that is IPSAS 1, we can say IPSAS 1, International Public Sector Accounting Standard number 1, prescribes the manner in which general purpose financial statements are presented presented by public sector entities, So mean that IPSAS 1 here basically prescribes, or in other terms, we can say it provides some rules and principles to be applied by the public sector entities, specifically when preparing now the general purpose financial statement. General purpose financial statement are financial statements prepared by these particular entities and to be used by various stakeholders. Now, equally, this particular standards, or we can say a complete set of financial statements comprises of the following components. Number 1, we have a statement of financial performance. This is equivalent to the statement of profit or loss for trading entities. Number 2, we have a statement of financial position. Number 3, we have a statement of cash flows. Number 4, we have a statement of changes in equity, also known as a statement of changes in net assets. Number 5, we have a statement of comparison of budget and actual information. Budget and actual information. And finally, number 6 here, we have the notes. We have notes to financial statements. So therefore, according to IPSAS 1, when a public sector entity is preparing financial statements, those financial statements should comprise of 6 components. We have the statement of financial performance, a statement of financial position, statement of cash flow, statement of changes in equity, a statement showing a comparison of the budget and actual information, and also now we have the the notes. Equally, this standard here, that is IPSAS 1, has gone further to prescribe or basically to outline some of the items which must be highlighted or which must be included in the notes. So therefore, maybe you can say that this, or maybe you can just talk over the items to be included in the notes, to be included in the notes. In the notes include the following. So number one, we have accounting policies, followed by that entity, or in other terms, we can just talk of accounting policies used by the public sector entity in terms of preparing its financial statement. This includes things like the method of depreciating assets and so on. Number two, we have the key assumptions, which equally were used in preparation of financial statements, And major, when we talk about the assumptions here, we are talking of the accounting concept, like the going concern, the accrual concept, and so on. So the other item which is also included in these particular notes is a description of the entity's operation, operations. The other content, or basically the other item which will be included in this particular note is what we refer as the domicile. And the legal form of the entity. The legal form, the domicile. Domicile, basically here we are talking of the country of operation, and the legal form. The legal form refers to whether the public sector entity is a county government, is it a parastatal, is it an arm of the central government, and so on. And also the other item to be included in this note is a reference to relevant registration. So when talk about relevance, that is reference to relevant registration, maybe you're talking of the registration, or basically the Act of Parliament, which governs the operation of such what a public sector entity. Because basically what we know is that most of the public sector entities like county government, parastatals, and so on, their operations is governed by a certain Act of Parliament or a certain registration. If it's something like Kasneb, the operation of Kasneb is governed by something called the Accountants Act. So in the notes, Kasneb, when preparing its financial statement, it can give a reference to that the operations are governed by what? The Accountants Act. So therefore, these are basically some of the items which must be highlighted in the notes which accompany this particular financial statement. So basically what I've said is that as far as this particular standard here is concerned, that is IPSAS 1, we are going to look on how to prepare two main components of financial statements. And that is the first one here, which is the statement of financial performance, and the statement of that is the statement of financial position. So let's start by looking on the first one, which is the statement of financial performance. Statement of financial performance, and I've said that it is equivalent to income statement, is equivalent to the statement of profit or loss, and this one is prepared to ascertain the performance of a public sector entity. So we can say that it is prepared to ascertain the performance of public sector entity. entity. And therefore, this one will be prepared to compare the total revenue, the total revenues of a public sector entity with what? With the total expenditures. Total expenditures. Any difference between these two, any difference between the total revenue and the total expenditures is a surplus or a deficit, simply because this, or basically the difference is not a profit or loss, simply because these particular public sector entities do not operate with an objective or with a motive of making a profit. Their objective, their motive is to provide essential services which are required by who? The members of the public. So how do we or how is this statement of financial position prepared in accordance with IPSAS 1? So let's look on the format. The format of the statement of financial performance. Statement of financial performance. So always we start with the revenue, because I've said we prepare this to compare the revenues and what? The expenditures. And here we just need to have a single column, just a single column. We take into account various incomes by public sector entities. This may include, number one, what refers as the transfer from exchequer. Transfer from exchequer, this is the amount of money allocated to a certain public sector entity, like a government department, like a government ministry, from the exchequer, or basically from the consolidated fund. We also have transfer from other ministries, So this is any amount of money received by a certain a certain what? A certain ministry, a certain government ministry from other ministries as a result of services rendered. So we also have fees, fines, and licenses. So this is basically the amount of money collected by a public sector entity from the services it rendered. And then maybe we also have things like other revenue, and so on. Other revenue, etc. So, and then what we do here, we get the total revenue. We get the total revenue. So from there we proceed and we record the expenditures. So the expenditures, this may include things like salaries and wages. Equally, we record it in that column. This will also include things like supplies and consumables which were used. This may also include things like the transfer to other ministries, and maybe things like the finance cost, the cost incurred as a result of raising finance cost. So, and then what we do, we get the total expenditures. Which now we can abbreviate this to be A here, and this to be B. So once we have the total revenue and the total expenditures, we just compare the two. We take this minus this, and the difference will be a surplus or what? Deficit. So the difference will be a surplus, if a positive, but if a negative, that will be a deficit for the year. So for the year, a positive is a surplus, a negative is what? Is a deficit. So therefore, according to IPSAS 1, that's how the public sector entities should present their statement of financial position, statement of financial performance. So let's move and look on the preparation of the second component, number 2, and that is a statement of financial position. So this one is prepared to ascertain the financial position of a public sector entity as at the end of the year. In other terms, this is a statement of asset, liabilities, and equity. So, but first of all, we can say that this is prepared to do what? To ascertain the financial position of a public sector entity as at the year end, or as at the end of the year, as at the end of the year. So, and therefore this one will be prepared to show the asset, the liabilities, the equity of a public sector entity. Now, the format which is used in terms of preparing this is a little bit different from the format which is used by private owned entities, because here we record assets, we less liabilities, we get the net asset, which is the difference between asset and liabilities, and then we record items of what? Of equity. So we can look on the format here. Let's look on the format of the statement of financial position. Financial position. Equally, in this case, we just need to have a single column. We always start by recording assets. And as per this standard, always a public sector entity should start with the current asset, not the non-current, but the current assets. Current asset will include inventories. These will include receivables. This may also include cash and cash equivalents. So therefore, it is important to note that here, unlike when preparing a statement of financial position under IS1, International Accounting Standard number 1, here we start with the current assets, because under IS1 we start with the non-current what? Asset. So then from there get the total, and then proceed, you record non-current assets. Non-current assets. So the non-current assets, these may include things like the PPE, property, plant and equipment, and any other etc. But mostly this is the common one. And then from there we get the total assets. Total assets. Maybe we can abbreviate that as A. Yes. So then from there we proceed, or basically then we record liabilities. And equally here we start with the current liabilities. Current liabilities, this will include payables. This may also include accruals, etc., and any other. We get the total current liabilities, and then from there we proceed and record liabilities, that is non-current liabilities. Non-current liabilities, which are basically the long-term liabilities. So in this case, you may be given something like a long-term borrowing, and maybe things like liability for long-term employees benefits. Long-term employees benefits. Yes, and then now from there we get the total liabilities. total liabilities. And these total liabilities, this one we can just refer to that as B. We can refer to that as B. So after getting now the total liabilities, we get now the difference between asset and liabilities. Yes, so we get something called the net asset. Net asset. So the net asset is the difference between asset and liabilities. Net asset, which will be equal to A, which is now total asset, minus B, the total liabilities. Total liabilities. And basically with the bordering third, because that is the end of the first part of our statement of financial position. And then finally we record equity. And basically this equity comprises of accumulated fund. Accumulated fund is the capital of these public sector entities, and we also to this we add accumulated surpluses. Accumulated surpluses. Surpluses, these are like accumulated profits, but in this case we talk of accumulated surpluses, and then to this now we add any other reserves. Any other reserves. And then we equally get the total here, which is total equity. Total equity, and basically the other name for total or for equity is what? Is net assets. Is net assets. Net assets. And basically now whatever you get here as the total equity or total net asset must be the same with the figure now which you get what there. So therefore that is a format which is used in terms of preparing or in terms of presenting a statement of financial position, which I've said is quite different from the format which is used under IS1, International Accounting Standard number 1. So that is basically what you need to know as far as the IPSAS 1 is concerned. So I want us, once we come back in our next session, we look on an illustration question regarding the preparation of those two components. Hi candidates, welcome to another session of Manifested Online Classes. My name is Joseph Kemanu, your lecturer for Financial Reporting, Advanced Financial Reporting. So in this session, I want us we look on an illustration question regarding a presentation of financial statement under IPSAS 1. Remember in our previous session, we discussed on what should be contained in a complete set of financial statements prepared by public sector entities, and also we looked on the format of preparing now the statement of financial performance and the statement of financial position. So in this session, I want us to look on an illustration question regarding preparation of the same. So let's go through that illustration and we see what we are told. It reads, the following information was extracted from the books of Ministry of Commerce and Industrialization for the year which ended 30th of June 2022, 30th of June 2022. So number one, we are given the cash and cash equivalents, and then we have the receivables, we have the accumulated surpluses on 1st of July 2021, and then we have the reserves, we have inventories, transfer from exchequer fees, fines and licenses, we have the exchange gain, we have other revenue, transfer from other ministries, payables, property, plant and equipment, wages and salaries, transfer to other ministries, supplies and consumables used, other expenses, finance costs, and then we have long-term borrowing, liabilities for long-term employees benefits, and then we have accruals. So from this information, what we are required to do, Roman 1, is we prepare the statement of financial performance for the year which ended 30th of June 2022, 30th June 2022, and statement of financial position is at 30th of June 2022. So let's start with the Roman 1 of that particular question, whereby we are required to prepare the statement of financial performance. So we need to have the title. The name of the ministry is Ministry of Commerce and Industrialization. industrialization. This is a statement of financial performance, which is for the year which ended 30th of June 2022. 30th of June 2022. Yes, so in this case, we just need to have a single column here, and our figures are in thousands of shillings. So what do we start with? We start with the revenues. So revenues, remember, these are incomes by this particular ministry. So what you just need to do is you go through the information which you're given there, and basically you see which items of incomes are you given there. So in our case, we have a number of items of incomes, starting from where we have the transfer from the exchequer. Remember, this is the amount of money allocated to this ministry here from the consolidated fund. So we have the transfer from exchequer, that is given as an amount of 37,500. So below that we have fees, fines, and licenses. So this is the amount of money collected from the services offered by this ministry. And then we have the exchange gain, that is still an income, exchange gain, which is a figure of 1,500. So then from there we have other revenue, which is a figure of 9,000. Okay, so then from there we have transfer from other ministries, which is still an income, transfer from other ministries. This is an amount of 750. Yes, so I think those are some of the items of incomes which are given. Maybe you can just counter check whether we have any other item. So below that we have payables, property, plant and equipment, wages, transfer to other ministries, supplies, other expenses, finance cost, long-term borrowing. Yes, so in our case, we don't have any other item of income or any other item of revenue. So we need to get the total revenue. But before we do that, we can first of all record the expenses or the expenditures. So we have expenditures or the expenses. That is just one and the same thing. So here we have equal number of expenses. We just need to identify which item of expense or which items of expenses are we given there. So number one, we have wages and salaries. Which is a figure of 15,000. Then we have transfer to other ministries. Which is a figure of 7,500. We then have supplies and consumables used. Supplies and consumables which are used, and that is an amount of 6,000. So then below that we have other expenses. Which is an amount of 18,000. And then below that we also have the finance cost. Remember, the finance cost is another name for the interest, which is paid by this entity as a result of borrowing, and that is a figure of 1,500. So maybe you can just counter check whether you have any other item of expenditure. Yes, up there we have cash and cash equivalent, receivables, accumulated surpluses, reserves, inventories. Okay, payables, property, plant and equipment. Yes, so I think in our case we only have those items: wages and salaries, transfer to other ministries, supplies, consumables, other expenses, and then we have what? we have the finance cost. And then from there, what we are going to do here, we're going to get the total expenditures or the total expenses. And then we less that from the total revenue so that we get now the surplus or the deficit for the year. The deficit for the year. So let's get the totals here. We start by getting the total incomes here, the total revenue. That will give us total revenue of 56,250. Then we get the total expenses or the total expenditures. Yes, that will give us 48,000. So what we need to do is we deduct those particular total expenditures from our total revenue. So assuming that is our A and that is our B. So to get the surplus or deficit for the year, we take A minus B. We take the total revenues minus what? The total expenditure. So we less that from 56,250. That will give us 8250. So that's basically how we present or how we prepare what we refer as a statement of financial performance. So then from there we move to Roman 2 of the question, whereby we are required to prepare the statement of financial position, statement of financial position. This one is as at the end of the year, as at 30th of June 2022. Equally here we just need to have a single column. What do we start with here? We start with assets, and first of all I've said as per IPSAS 1 we start always by recording the current assets. So which items of current asset do we have here? So the first item from the balances we are given here is cash and cash equivalents. Cash and cash equivalents. So that is the first item of a current asset, which is 11,250. So below that we have receivables. A figure of 3,000. 3,000. And then we have accumulated surpluses. This is basically a component of equity. Reserves is a component of equity. And then below that we have inventories. Inventory still is an item of what? Of current assets, which is 1,500. 1,500. Okay, so we have that. Do we have any other item of current asset? No. So what we need to do, let's get the total here. But before we do that, let's first of all we record non-current assets. So for non-current assets, which items of non-current asset do we have here? For non-current assets, I think we only have one item, and that is property, plant and equipment. Property, plant and equipment, which are tangible non-current assets. And you're given the value for that as what? 60,000. 60,000. Yes. So then from there, what we need to do next is we get the total assets. So of which now the total asset here will be equal to non-current to the current asset minus, sorry, that is current assets plus non-current asset. But let's first of all compute the total current asset, which will give us 15,750. We add 60,000, which will give us a total asset of 75,750. So then next, what do we record? Liabilities. Next, we record liabilities, and we always start with the current liabilities, which are short-term liabilities. So from the information which are given in that particular question, we have various current liabilities including what? Including payables. Including payables, that is a figure of 7,500. And then we also have accruals. We also have accruals, which is a figure of 7,500. 7,500. Do we have any other item of current liability? No, no. So we can get the total, which will be 15,000, and then we record non-current liabilities. Non-current liabilities. Non-current liabilities, we have a number of them. Number one, we have long-term borrowing. Long-term borrowings, which is given as a figure of 15,000. We also have liabilities. Liabilities for long-term employees benefits. Long-term employees benefits. Benefits for long-term employees benefits, which is 3,000. 3,000, yes. That's what we have. Do we have any other? No. So what we equally need to get here is the total non-current liabilities. This will give us 18,000. 18,000, that is 15. So then we get the total liabilities. Total liabilities will be current plus non-current. This will give us a total of 33,000. And then next we get something known as the net assets. So the net assets, this one is equal to total assets minus total liabilities. So net assets, which is A minus B, which is this figure minus 33. So let's work out that. We see what will be our net asset here. So that will give us 42, 750. That is the net asset. And then next, what we need to record is equity. And basically equity, this one comprises of accumulated FUD and what? Surpluses. So I think in our question there, we don't have any accumulated FUD, which I said is another name for capital of these particular entities. But I think in our case, what you're given here, we're given accumulated surpluses at the start of the year. Accumulated surpluses at the start of the year. This is a figure of 75, which is like the accumulated profit at the start. So to this, what we add is the surplus for the year. Surplus for the year. So the surplus for the year is what we have here, the figure of 8250 there. We get the total, which will be 15,750. So that now will be the accumulated surpluses at the end. And then we need to check, do we have any other item of equity? Yes. So from the question which you are given, or from the information which you are given, we are given reserves. We are given reserves, which is a component of equity, and that is a figure of 27,000. 27,000. So we need to get the total net assets, or basically the total equity here. Total equity or total net assets by adding these two. That will be 750 to 4. So that is a 42 750. And basically this one should always be the same with the figure which we have there, which we have up there. And actually you can see the two figures actually reconcile. So that is it, that what was required as far as that particular question was, or as far as that particular illustration was concerned. It relates to the preparation of what? Of financial statement by public sector entities. So for now is a bye. See you in the next session.
Hello everyone and welcome back to the lesson. We are continuing the subject accounting, financial accounting. The topic is partnership accounting. In our last session, we wound up on the subtopic admission of a partner. We did an illustration. Today we are moving on to dissolution of a partner. And in this lesson, we'll be studying the causes of dissolution of a partnership and also the accounting treatment on dissolution of a partnership. What entries are made in the books of accounts upon dissolution of a partnership? That's what we are going to consider in our today's lesson. So welcome to the lesson. But first of all, we're going to define dissolution of a partnership. What does that mean? What does dissolution of a partnership mean? Dissolution comes from the word dissolve. And therefore, the dissolution of a partnership refers to the legal process of ending the relationship between two or more partners who are operating a business together as partners. You understand? It is the process of ending the relationship between two or more partners. And there are various reasons why a partnership may be dissolved. The first reason is mutual agreement. Reasons for dissolution: partners may dissolve a partnership through mutual agreement or mutual consent. Just the same way they came together to form a partnership out of mutual agreement, they may also agree to dissolve the partnership for various reasons, such as changes in their personal circumstances or even disagreements about the direction of the business and so on. So the partners can mutually agree to dissolve a partnership. 2, expiration of partnership term. Expiration of a partnership term. If the partnership was formed for a specific period of time, say 5 years or 10 years, then upon expiration of such a term, then the partnership can be wound up. It can be dissolved at the end of the term, unless the partners choose to renew it. Unless they do what? Unless they choose to renew it. If they had agreed that they will end the partnership in 10 years, then they can dissolve the partnership in 10 years. Alternatively, they can decide to renew the partnership agreement. 3, death or incapacity. Death or incapacity. That is the death of a partner, or if a partner becomes incapacitated, then the partnership may be dissolved. If one or more partners die or becomes incapacitated, then the partnership may be dissolved. Do you understand? Bankruptcy. Number 4, bankruptcy. Bankruptcy of a partner can be a reason for dissolution of a partnership. If one of the partners declares bankruptcy, it may lead to the dissolution of the partnership, depending on the terms of a partnership and so on. Bankruptcy. Court order. A partnership may be dissolved due to a court order. The court may order the terms or the dissolution of a partnership. a court may order the dissolution of a partnership. For example, if one or more of the partners engage in misconduct, or if there is any breaches of the terms of the partnership, then the court can issue an order for the partnership to be dissolved. So these are some of the reasons why a partnership may be dissolved. 1, mutual agreement. 2, expiration of partnership term. 3, death or incapacity of a partner. 4, bankruptcy of a partner. 5, through court order. So we are now moving on to discuss the accounting treatment. Accounting treatment of dissolution of a partnership. Let's begin on page 1. Now, candidates, the first thing to do on dissolution of a partnership is to open a realization account. 1, open a realization account. This account is used to close down all assets and liabilities except cash and bank account. So a realization account is an account that is used to close all assets and liabilities apart from cash and bank. And it is from this account that assets will be disposed and liabilities cleared. So first of all, when dissolving a partnership, open a realization account. Then number 2 is to transfer all assets to the realization account except cash account and bank account. Transfer all assets to realization account except cash account and bank account. That is a process of closing down the assets accounts. And you do so by debiting the realization account and credit the specific assets account. You understand? Debit realization account, credit assets account. So that if you have, say, an asset like, say, land account, and there is a balance here of, say, 10 million. So you'll open the realization account, open this realization account. So you credit the cash, the asset account, realization 10 million. So you credit the asset account 10 million, then debit the realization account with land 10 million. So you see, you will have closed this. If you add here, you have 10 million, add there, you have 10 million. So there is no balance on this asset account. So you do the same for all the assets. So that is closing down all assets. You debit realization account and then credit assets account. Credit assets account, debit realization account. You see, this one is open. So you'll have all assets listed here. And every specific asset is credited. You close down all the assets account. Do you understand? Transfer all the assets except cash and bank to the realization account. And that essentially closes down the affected assets accounts. And it's important to note here that intangible assets like goodwill will also be treated as any other assets by transferring it to the realization account. So these assets include goodwill, except bank account and cash account. And where a partner takes an asset, then that should be charged upon the partner's capital accounts at an agreed value. Where a partner takes an asset, when winding up, a partner may say, you want that computer, I'll take that motor vehicle, I'll take this building. So where a partner takes an asset, candidates, you are saying you will debit the partner's capital account and credit the realization account. So you debit the capital account, partner's capital account, then credit realization account. You understand? Where a partner takes up an asset, this should be charged upon the partner's capital account at an agreed value. So if a partner say takes this land, then the realization account will be credited and the partner's capital account will be debited. Let me put partner here so that we are accurate. Partners capital. It's not just capital, but partners capital. Now, this is where a partner takes an asset. How about where the asset is sold? For sale of an asset or assets, for sale of an asset, what happens? You debit bank or cash account. You debit because you sold an asset, money comes into the bank or comes into the cash account, so you debit bank or cash account, then credit realization account. So where an asset is sold, first of all, we said all assets are debited here. So when you are selling this asset, you see, you will credit this asset account, then debit bank account. You understand? So we've dealt with assets. Now let's move on to liabilities. Here we've dealt with assets. Then there is liabilities. What happens with the liabilities? Liabilities like creditors, like loans, and so on. Transfer all liabilities to the realization account. On dissolution of a partnership, all liabilities are transferred to the realization account by debit liabilities account and credit realization account. So if you have a liability like, say, creditors, for example, creditors account, You know, liabilities accounts always have a credit balance. So if you have a balance here of say 15 million, you've seen here that you debit liabilities account. So you'll have come here and debit realization 15, then realization account. On realization account, you credit with creditors 15 million. So by debiting this liabilities account, we effectively close it. See, there's no balance there. So transfer all liabilities accounts to the realization account. And this, all the liabilities will appear on the credit side of the realization account. Realization account. Now, where a partner takes up a liability, where a partner takes up a liability, what entries do we make? Debit realization account and credit the partner's capital account. You will debit the realization account and debit the partner's capital account. And where reserves are in existence, where reserves exist, if the partnership has reserves, then what entries do we make? Because we know candidates' reserves have debit balances. A reserve will have a debit, credit balance. Reserves will always have credit balance. If there's a balance here of say 5 million, how do you close that reserve? That reserve has to be debited with partner's capital account. So we debit partner's capital accounts, right? You debit reserves, not partners, but reserves, debit reserves. We've seen to close this account, you debit it with the partner's capital. So we debit reserves account and credit partners capital accounts. So do you understand, candidates? Where reserves exist, I've said reserves always have a credit balance. So to close that reserve account, you debit reserve with partner's capital account, then credit the partner's capital account. And that is obvious because before dissolution, these reserves, these are monies for the partners, the monies that were not appropriated. Reserves are unappropriated amounts, undistributed profits. So the partners' accounts ought to be credited, give them their money. And that has to be done in the profit sharing ratio. If the amount is 5 million and the ratio is 1:1, if there are two partners, then you split 50-50, 50%. So you credit the partners' capital accounts in their profit and loss sharing ratio. Next is payment of realization expenses. What entries are made where there are realization expenses? To realize these assets, expenses may be incurred. So you debit payment of realization expenses, you debit, of course you have to credit the bank or cash account and debit realization account, debit realization account, debit the realization account, and credit cash or bank account. Bank or cash account. Payment of realization expenses, debit realization account, credit bank account. Then lastly, candidates having closed, first of all, we began by opening a realization account. Then all assets are transferred to realization account. All liabilities are transferred to realization account. If there are any reserves, they are if there are reserves, where there are reserves, the reserve account is debited, partner's capital account is credited. Then there is payment of realization expenses, which is debited, realization account is debited, and bank account credited with the amount. You understand? So having entered all these entries, then we close the realization account. Close realization account. Close realization account. And remember, it is through realization account that the accounts are closed. So having transferred all the assets and liabilities to the realization account, there may be a balance. There could be a balance in the realization account, which could either be profit or loss on dissolution. You understand? Let me demonstrate briefly. We've said that the realization account, this realization account, on this account, we've indicated that assets are debited here. You have assets, land, buildings, everything, goodwill. Then liabilities are credited here. Expenses are debited. The realization expenses, you see that you debit the realization account with realization expenses. So in closing this account, we may have a debit balance or a credit balance. The balance in the realization account would show either a profit or a loss on dissolution. If it is a profit, then it is transferred to partners' capital accounts in their profit sharing ratio. If it is a loss, it's also transferred to the partners' capital accounts in their profit sharing ratio. So you add the debit side, add the credit side. So you add this side, get the total, then you add the credit side, get the total, then you'll either have a balance on this side or a balance on this side. For example, this could be, say, 100 million, and here we have 120 million. So you see there'll be a balance on this side of 20 million. So it is this balance that we are saying ought to be transferred to the partners' capital accounts if you have partner A and B. So this 20 million is transferred, assuming it is in the ratio 1:1, then this will be 10 million, 10 million, 20. So the double entry will be to credit the partner's the partner's capital accounts. So you'll have the partners here, A, B, double entry. This is partners' capital accounts. So this is debited, 10 million, 10 million. So you'll have here realization, 10 million, 10 million. That is if the balance is on the debit side. And that will indicate that this is profit. If the balance is on the debit side of the realization account, then that is profit on realization or on dissolution. So profit on dissolution is 20, and it is distributed among the partners in their profit share ratio. But if the balance was to be on this side, then again it will be transferred to the partners' capital accounts, but it will appear on the debit side. A, B, 10, 10. And that would indicate that this is loss on dissolution. If it appears on the debit side, it is loss. If it appears on the credit side of the partner's capital account, that is profit on realization. So here we've said, having entered all the entries in the realization account, then you close it. Close the realization account. And this is how you close it. You close it to the partner's capital accounts. Close it to the partner's capital accounts, either as loss on dissolution or profit on dissolution. So close the realization account. Close the realization account. So you said that in case you close, there are two ways. In case of a profit on realization, in case of a profit on realization, we say that you debit the realization account, debit the realization account, and then credit the partners' capital accounts, debit realization account, credit partners' capital accounts in their profit sharing ratio in case of profit on realization. There may also be loss on realization. In case of loss on realization, in case of loss on realization, in case of loss on realization, you debit partners' capital accounts and then credit the realization account. In case of a loss, debit partners' capital accounts with that loss in their profit sharing ratio. But in case of a profit, you will credit the partners' capital accounts. You understand? So that will be the accounting treatment on dissolution. Remember, we also mentioned something about the treatment of goodwill. We say that if goodwill appears in the statements of financial position, then goodwill should be treated just like any other asset. It should be transferred to the realization account. And if goodwill does not exist in the balance sheet, then no entry is passed to the realization account. You understand? So that is all we can say in relation to accounting treatment of dissolution of a partnership. And we started by noting that when dissolving a partnership, first of all, you open a realization account. You open it. Then the first thing to do is to transfer all assets to the realization account except cash and bank. Transfer all assets to the realization account except cash and bank by debiting realization account and crediting the assets account. And we saw that where a partner takes up an asset, then you debit partner's capital account, then credit realization account. Where there is sale of an asset, if the partners decide to sell an asset, then debit the proceeds in the bank, credit realization account. So that is A, B, C. A, B, C deals with assets. Then D here deals with liabilities. After having made the accounting entries for the assets, then you proceed to transfer all liabilities to the realization account. So you debit liabilities account and credit realization account. So you'll have on the realization account on the credit side all the liabilities. Where this is E, where a partner takes up a liability, then the realization account is debited, partner's capital account credited. If reserves exist, this is F. If the partnership has reserves, and we say that reserves are undistributed profits, these reserves, you debit reserves account and credit partner's capital account. By crediting partner's capital accounts, you'll be giving the reserves to the partners because you are closing the books. You close the reserves account to the partner's capital account. That is F. Then G, we have payment of realization expenses. If there are any expenses that may be incurred when selling assets or dissolving the partnership, then you debit realization account and credit bank account with the realization expenses. Then lastly, we have G. Close the realization account. And I've demonstrated how you close it here. Before you close the realization account, we say that you add the debit side and the credit side. So you'll either have a debit balance or a credit balance, which should be closed to the partner's capital account. You say that in case of a profit or realization, debit realization account, credit partner's capital account. But in case of loss on realization, you debit partner's capital accounts and credit the realization account. So you'll see you have closed all the accounts except cash and bank. So up to this point, candidates, you'll have closed all the accounts, you've closed all the assets, you've closed all the liabilities, you've closed all the reserves, you've paid realization expenses. So what remains is the bank account. Remember, we say that all these are transferred to realization account except cash or bank account. The bank account, remember this is the account where money has been paid. If expenses are paid here, if a partner buys an asset, the money comes to the bank. So you may find that bank account has some balance. It could be debit balance or credit balance. So at this point, again, you know, we've not closed the partners capital accounts. So at this point, all accounts have been closed except these two. And these are the last entries to make when accounting for dissolution of partnership. So these are the two accounts that are finally closed. Because remember, this bank account and cash account were not closed. The partner's capital account is also still open. Because here you see, the last thing we did when closing the realization account is to take everything to the partner's capital account. So this partner's capital account is still open. So depending on the amount, the balance in the bank account, assuming this account has, say, 50 million. If the total is 50 million, this I'm talking about balance carried down. If balance carried down is 50 million, this side, balance carried down is 50 million. So if here on this account we have 50 million. So here there is 50 million. So this 50 million, you close this bank account to the partner's capital account, depending on the balance. If the balance is on this side, you close it here. The balance is there, you close it here. So these are the last two accounts that are closed after closing the realization account. So you see, it is a process. You transfer everything to the realization account, then you close the realization account. Do you understand? Every asset is transferred to the realization account. Every liability is transferred to the realization account. All reserves are transferred to the realization account. Then you close it to the partner's capital accounts. So you recall, all assets are transferred to this realization account apart from bank and cash. So these two assets are the ones that are finally closed. If there is any money in this bank account, you distribute it to the partners in their profit sharing ratio. Later on, we'll be studying what to do if we have debit balances on the cash on the partners capital accounts. There could be that the money that is paid here, candidates, if you have A, B, and we have all these balances, any amount that appears on the credit side of the partners capital accounts is money that the partnership owes the partners. All the credit items or entries in the partners capital accounts represents the money that the partnership owes the partners. And when payment is made, this account is debited. The money from the bank will have bank here. It's debited to clear this balance. And we'll be studying later on how to do that. These are only the entries. In our next session, we are going to look at a practical question that will help us reinforce what we've learned in today's lesson. Thank you for attending the lesson. God bless you. Bye-bye. Hello learners and welcome to the lesson. The subject is auditing and assurance. In our today's lesson, we are going to analyze the differences between computerized systems and manual systems, because there are key differences between the two, computerized and manual systems. And to help us analyze, I'm going to do it in columnar format. I'll give the basis for distinction, then we'll distinguish between computerized and manual systems. So the first basis of distinction is data processing. Data processing. Data processing. The way data is processed in a computerized system is different from the way it's processed in a manual system. In a computerized system, data is processed electronically. Data is processed electronically in a computerized system. All right? Using computers, using software, which enables faster and more efficient processing, more efficient or accurate calculations and analysis. Data in a computerized systems is processed electronically using computers. In manual systems, data is processed manually. Data is in a manual system processed manually by human beings using paper-based records, requiring more time, requiring more effort, and increasing the potential for errors. Do you understand? Data is processed manually using humans. Using humans or human beings, they use their hands. Okay? In a computerized system, data is not processed using human beings. It is used, but process, it is, of course, the human beings are used to key in the data, but the processing part, like calculations, that is done by computers. So that's the first distinction between computerized systems and manual systems. The second basis is storage. Storage. This is using, let me write, using computers. This is manually using humans. The second basis is storage. 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 Number two, storage. How is data stored in a computerized system? Is it different from a manual system? Yes. Now, computers can store vast amounts of data electronically. Vast amounts of data is stored in computers, in databases and servers. Stored electronically in databases and servers. Large volumes of data can be stored electronically in databases and servers. That is in a computerized systems. In computerized systems, data is stored electronically in databases and servers, offering virtually unlimited storage. Offering virtually unlimited storage. Okay? The storage is unlimited. That capacity is not limited. But in a manual system, we have a limited data storage that is limited to physical storage space. Is limited to physical storage space. In a manual system, data is limited to physical storage space, but here you have seen it's stored in databases and unlimited spaces, okay, virtual spaces, unlimited virtual spaces. Manual is limited to physical storage spaces. Do you understand? You understand the difference? This is unlimited virtual space, limited physical storage space. And candidates in a manual system, data is limited to physical storage space, and also which can then become cumbersome or difficult to manage as data volume increases. You understand? You are distinguishing on the basis of storage. In manual system, it is limited to the physical storage space, which is available for paper records. Available paper-based records like physical files, papers. Here it is virtual. The third distinction can be based on data manipulation and analysis. Data manipulation and analysis can be a basis for distinction. Manipulation and analysis. Now, in a computerized system enables easy manipulation. It enables easy manipulation. It is easy to manipulate data that is stored in a computerized system. Easy manipulation, easy sorting. You can use software to sort data. You can use software to filter. Sorting, filtering, that is how you manipulate, and even analyzing data through software tools. Through software. It is easy to manipulate the data that is stored by sorting, filtering, and so on using software tools. But in a manual system, it requires manual sorting. Requires manual sorting. Data can only be sorted manually, which can be cumbersome if you are dealing with large sets of data. To analyze, to manipulate large sets of data in a manual system can be cumbersome. It can be time consuming and prone to errors. In the process of manipulating data in a manual system, the one who is doing the work can easily make mistakes, particularly when dealing with large volumes of data sets. The fourth distinction between computerized systems and manual systems is in relation to security risks. Security risks. In a computerized system, computerized systems are more vulnerable to security risks. More vulnerable to security risks. Computer systems are more vulnerable to security risks, more vulnerable to security risks like hacking, like malware, like data breaches, necessitating the company to put in place robust security measures to protect the data from breaches, hacking, and so on. You understand? That is computerized systems. For manual systems, Manual systems are less susceptible to cyber attacks. Less susceptible to cyber attacks. There is limited potential to cyber attacks. But they are vulnerable to physical damage. That is still risky, but vulnerable to physical damage. Like papers. Papers can be destroyed by fire. Papers can be stolen physically. Okay? Because they are paper-based records. They are vulnerable to physical damage, vulnerable to theft, or even loss of paper-based records. 5, let's distinguish the two based on skills and expertise. Skills and expertise. Skills and expertise. Now, computerized systems require specialized technical skills. Require specialized technical skills. Expertise require specialized technical skills to operate, to maintain, to troubleshoot software and hardware components, and so on. But for manual systems, require less specialized skills. Require less specialized. They require less specialized skills as data processing and record keeping are done manually. You don't require special skills to file documents, but you require special skills to manipulate computerized systems. You require specialized skills to troubleshoot, to maintain, to operate a computerized system. Then number 6, we have error handling. Error handling. Error handling. Error handling. Now, a computerized system can incorporate error handling mechanisms, can incorporate error checking mechanisms, can incorporate error checking mechanisms. Computerized systems can incorporate, error checking mechanisms can be incorporated in a computerized system. We may have even validation rules to minimize errors during data entry, during processing. Computers can alert one when there are errors at the input stage. How about manual systems? Manual systems are prone to human errors due to manual data entry. Are prone to human errors. Are prone to human errors because the data is inputted by human beings. Data, when dealing with data, when processing data, that is done by human beings, and human beings, due to fatigue, due to stress and other factors, they are prone to make errors. They are prone to make errors due to manual data entry. Human beings can make errors during calculations, during transcription, and so on. So these are 6 differences based on data processing, storage, manipulation, security risks, skills and expertise, error handling. So when distinguishing between computerized systems and manual systems, please remember the basis for distinctions. The basis for distinctions. And that is the end of the lesson. I'm going to give you today's assignment. Number 1, identify and explain 5 key differences between computerized and manual accounting systems in terms of data processing, storage, control, security, skills, expertise, error handling, and so on. Number 2, how do the differences between computerized and manual systems impact the audit approach and procedures? 3, what are the specific risks associated with computerized systems that are not present in manual systems, and how can these risks be mitigated? 4, how does the audit trail differ between computerized and manual systems, and what implications does this have for the audit process? Number 5, discuss the impact of computerized systems on the segregation of duties and how this can be addressed in an audit context. In our next lesson, we are going to study the benefits and drawbacks of computerized accounting systems. Bye.
Hi candidates, welcome to another session of manifested online classes. We are still continuing the topic of group accounts, and in this session I want us to look on different types of group structure, and basically how we go ahead and prepare the consolidated financial statement in case of those different types of group structure. Now generally we have two types of group structure. The first one is called the horizontal structure, whereby the parent company do have a direct shareholding in a number of subsidiaries, and then we also have another type of a group structure which is called a vertical group structure. So in case of a vertical group structure, this whereby the parent company will be having a direct shareholding in a subsidiary and also having indirect shareholding in something called a subsidiary. So therefore maybe in this case we can say that there are different types of group structure, including number 1, we have the horizontal structure. Number 2, we have the vertical structure, and also number 3, we can talk of the mixed structure, or basically the mixed group structure. So these basically are the different types of group structure. Maybe you can start with the first one, that is the horizontal structure. So when talk about the horizontal structure, this whereby the parent company do have or is having direct shareholding in a number of subsidiaries. For example, in this case, we can be told that A Limited, which is basically the parent company, has acquired some shareholding in B Limited, C Limited, and also D Limited. So mean that the parent company here do have direct shareholding in a number of subsidiaries. So therefore, you can say that this is where the parent company, remember also the parent company here is called the investor because it has invested in other entities. The parent company or the investor has a direct shareholding, in two or more subsidiaries, two or more subsidiaries. So the parent company here is having direct shareholding in two or more subsidiaries. So a good example of a horizontal structure, let's assume that we have A Limited, and which is the parent company, So this company may have direct shareholding in a number of subsidiaries. For example, B Limited or A Limited may be having 80% shareholding in B Limited. A Limited also may be having something like 60% shareholding in C Limited, and also A Limited may be having like a 75% shareholding in another subsidiary, say D Limited. Now, this particular type of group structure, we refer to it as the horizontal group structure, because you can see the parent company, which is A, is having direct shareholding in 3 subsidiaries: B Limited, C Limited, and also D Limited. Now, in this case, when preparing the consolidated financial statement, we prepare them in the normal way, just like a case whereby the parent company is having a single subsidiary. Basically, what that means is that when preparing the group account, we add similar items of asset and liabilities of all the companies here. That is the parent company, B Limited, C Limited, and also what? D Limited. So therefore, you can say in this case, the group accounts are prepared in the normal way, i.e. by adding similar items of assets, liabilities, revenue, and expenses, of the parent company and its subsidiaries. So therefore, in case of what we refer as the horizontal group structure, the group accounts are prepared in the normal way. Basically by adding similar items of asset, liabilities, revenue, and expenses of all the companies within the group. The group. So let's move and look on the other type of group structure, which is number two, and that is vertical structure. So in this case, when we talk about a vertical structure, this whereby the parent company is having a direct shareholding in a subsidiary, and then also having indirect shareholding in what we refer as a sub-subsidiary. So therefore, you can say that this is where a parent company is having direct shareholding in a subsidiary company, and also indirect shareholding shareholding in a subsidiary. So the parent company here will be having a direct shareholding in a subsidiary company, and also indirect shareholding in what we refer as a sub-subsidiary. So what do you mean by that? Let's assume that we have 3 companies, and A Limited here, we are told, for example, acquired 80% of the ordinary shares issued by B Limited, and then in turn, B Limited here has acquired a 60% shareholding in another company here, which is called C Limited. Now, this particular type of group structure, we refer to it as a vertical group structure, because the parent company here, which will be which is A, is having direct shareholding in this subsidiary, and then A Limited, which is still the parent, is having indirect shareholding in C Limited, of which C Limited in this case is referred to as the sub-subsidiary. is referred to as a subsidiary. Now, when preparing the group account, or basically the consolidated financial statement, in case of a vertical group structure, there are some important points which now the candidate must be able to know, and which basically will help them in terms of preparing the group account of such questions having that type of group structure. So these are some of the important points to note. Number one, when dealing with a vertical group structure, these are some of the important points. Number one is that the candidates must compute the parent company indirect shareholding in the subsidiary. That is the first thing to be done. Compute the parent company indirect shareholding in the subsidiary. Indirect shareholding in the subsidiary. In the subsidiary. So how do we compute that particular parent company indirect shareholding in this particular subsidiary? So what we do, we take the parent company shareholding in the subsidiary. So for example, assuming A Limited, which is the parent company, has 80% shareholding in B, which is the subsidiary, and then B, which is a subsidiary, or basically do have a shareholding of 60% in C. So to compute the parent company indirect shareholding in C, we take the parent company shareholding in the subsidiary, which is 80%, and then times the subsidiary company shareholding in the subsidiary, which is 60%. So in this case, or here we are going to get a rate which is 48%. So here we say that the parent company indirect shareholding in C, or basically in the subsidiary, is 48%. But in this case, despite or even if you get a rate which is less than 50%, still we say that the parent company is having indirect shareholding, or basically indirect control in C Limited, simply because A Limited controls this one, A Limited controls B, A Limited controls B, and then B Limited in turn controls C. Controls what? C. And because this controls this one, and this one controls this one, then in this case we say that this company here, that is A Limited, do have indirect control over the operating and financial decisions which will be made by C Limited, and also A Limited will be having indirect control as far as the composition of the board of directors of C Limited is concerned. So therefore, what you are saying is that provided this company is controlling this one and this one is controlling that one, even if you get a rate which is less than 50%, then that company is still a subsidiary. What that means is that when preparing the consolidated financial statement, you have to consolidate, you have to combine, you have to add together similar items of assets, liabilities, revenue, and expenses of all the companies. So that is the first thing when dealing with a vertical group structure. Compute the parent company indirect shareholding in the subsidiary. Number two is you need to identify the date, identify the date when the subsidiary became a member of the group. So number two, we can say identify the date when the subsidiary became a member of the group, became a member of the group. And basically that particular date is very, very important, because when, for example, preparing number one, when computing the goodwill of the subsidiary, you compute it on this particular date when the subsidiary became a member of the group. And also when preparing something like the consolidated income statement, you prepare, or basically you take into account the result of the sub-subsidiary from the date it became a member of the group. That is why we are saying it is very, very important for you to be able to identify the date the sub-subsidiary became a member of the group. And actually, the sub-subsidiary is said to have become a member of the group on the later of the two dates between the date when the parent company acquired the subsidiary and the date when the subsidiary acquired the shareholding in what? In the sub-subsidiary. So therefore, you can say that the sub-subsidiary becomes a member of the group, becomes a member of the group on the later of the two dates, on the later of the two dates. So which are those particular two dates? We are talking of the date when the parent company acquired the subsidiary, and the date the subsidiary acquired the sub-subsidiary. So basically we are saying that the sub-subsidiary will become a member of the group on the later of these two dates. The later of the date the parent company acquired the subsidiary. So like maybe let's assume that we are told A Limited acquired shareholding in B maybe on 1st of January, like 2021, and then B Limited acquired 60% shareholding in C on 1st of January 2022. Therefore, in this case, we are saying the sub-subsidiary will be deemed to have become a member of the group on the later of the two dates, the date which is later. Basically, the date which is later is basically this one. That is 1st January 2022. So therefore, when computing now the goodwill on acquisition of this particular sub-subsidiary, we compute it on that date. That is 1st January 2022. And also when preparing now the group account or the consolidated financial statement, we must also know that we are going to consolidate the result of that particular subsidiary from that particular date. That is the other important point when dealing with a vertical group structure. Other than computing the parent company direct shareholding in C, you also need to identify the date when the sub-subsidiary became a member of the group, of which you have said it must be the later of the two dates. So the other important point number three, is regarding the cost of investment. Cost of investment in the sub-subsidiary. So when talk about the cost of investment in the sub-subsidiary, we are talking of the purchase consideration which was paid by the subsidiary in acquiring the shares of the sub-subsidiary. Now, this particular cost of investment in the sub-subsidiary usually is split into two parts. So first of all, we compute the amount due to the parent company, or we compute, yes, amount due to a parent company. So when talk about the amount due to the parent company, this is actually the amount which is regarded or which is assumed to be paid by the parent company in acquiring the shares of the sub-subsidiary. So how do we compute that amount due to the parent company? So this one is computed by taking the cost of investment in the subsidiary. We compute this by taking a cost of investment in subsidiary times the parent company shareholding in subsidiary. A parent company shareholding in the subsidiary. Parent company shareholding in the subsidiary. Like in this case, assuming we are told that B Limited, in acquiring the shares of C, may be paid 100 million. Paid 100 million. So how do we compute the amount deemed to be paid by the parent company? So we take the cost of investment in the subsidiary, which we are given there as 100 million, and then multiply that with the parent company shareholding in the subsidiary. So the parent company shareholding in the subsidiary is 80%. So in this case, we get what? We get 8 million. So this is the amount deemed to be paid by the parent company in acquiring shares of the subsidiary. And this particular amount which we get here is the one which is then used in the computation of goodwill. So we can say that this is the amount used by parent company in computing the goodwill of the subsidiary So therefore, that this particular amount here, we use it in computing the goodwill of what? Of the subsidiary. Then from there, we also compute the amount of purchase consideration due to the NCI. It is important to note that in this particular subsidiary company here, the parent company is having 80% shareholding, meaning that the remaining 20% of the shares in this particular subsidiary here are held by the minority shareholders. And basically we said the interest of the minority shareholders in a subsidiary, we refer to it as NCI, non-controlling interest. So therefore, what we do next here is to compute amount due to NCI. Compute the amount due to NCI. So how do we compute this particular amount due to the NCI? So we take the cost of investment, in subsidiary, and then we multiply that with the NCI shareholding in a subsidiary. NCI shareholding in the subsidiary. For example, in this case, assuming the cost of investment in the subsidiary is 100 million, so we have to multiply that with the NCI shareholding in the subsidiary. NCI shareholding in the subsidiary is 20%. So this will give us what? This will give us 20 million. So this particular amount of 20 million is then deducted from the NCI at the end of the year. So we can say this is deducted from NCI at the year end. NCI at the year end. So when computing the NCI at the end of the year, so that particular amount due to the NCI, we are saying, will be deducted from what? From the NCI. So therefore, it is very, very important to note that when dealing with a subsidiary, for example, in our case here, C Limited, number one, in computing the goodwill on acquisition of a subsidiary, we have to compute it on the date the subsidiary became a member of the group. Actually, we have mentioned something here to do with identifying the date when the subsidiary became a member of the group, of which that should be the data of the two dates. That is the first important point as far as the computation of goodwill of the subsidiary is concerned. Number two is that when taking into account the cost of investment in the subsidiary, we don't take the full amount. If, for example, B Limited had paid 100 million in acquiring the shares of C, that is not the amount we use in computation of goodwill, but we use the amount which is regarded to be paid by the parent, because it is a parent company here which compute the goodwill on acquisition of C. The goodwill on acquisition of C is not computed by B, because it is important for you to note that in a vertical group structure, here we can say generally we have two parent companies. So A is a parent company to B, and then B is a parent company to C. But this company here, that is B Limited, in accordance with IFRS 10, it is exempted from preparing the group account because it is a partially owned subsidiary by A Limited. The company which is
Hello and welcome back to the lesson. Today we are going to analyze the benefits and drawbacks of computerized accounting systems. So by the end of this lesson, you should be able to explain the benefits and the disadvantages of computerized accounting systems. We're going to begin with the benefits. What are the benefits of computerized accounting systems? The first obvious benefit is in relation to speed and efficiency. Speed and efficiency. Computerized accounting systems are efficient and fast, right? The computerized systems automate calculations. That's why the speed is very high, because calculations are automated, data entry is automated, and also report generation, significantly reducing the time and effort that is required for accounting tasks. So computerized systems automate calculations, data entry, and report generation, and to a very great extent reduce the time and effort that is required for accounting functions or tasks. 2, accuracy. Accuracy. Automated calculations minimize the risk of human errors that occur in manual bookkeeping, which ensures more accurate financial records. Human beings are prone to make mistakes. That's why when the accounting system is automated, then that element of human error is minimized, and that increases the accuracy of financial records. 3, data accessibility and organization. The third benefit is in relation to data accessibility and organization. Data is easily stored, data is easily organized and retrieved in digital formats, which enables quick access to financial information for analysis and decision making. It's very easy to share data that is in digital format compared to physical data. And that helps in accessing the data and organizing the data. Data that is in physical format, data that is in computers can easily be stored, can easily be organized, and can easily be retrieved, which enables quick access to financial information and records. 4, real-time reporting. Real-time reporting is very easy to generate up-to-date financial reports on demand, which provides a clear and current picture of a business financial health. Data that is digitalized, data that is computerized is easy to generate, all right? That data can be used to generate very quickly reports which could be needed on demand, and that provides a current picture of the business situation. There is a benefit related to cost. Here we are referring to savings, cost savings. Now, computerized systems reduce the need for manual labor, reduce the need for paper-based records, potentially lowering operational costs in the long run. When you have a computerized system, you don't need many people to help you in organizing the data or keying in data. You save on human labor, you save on files, because if data is not stored in the computer, it may be stored on shelves, in files on shelves. That one is saved because it's cheaper to have all the information in one computer. Cost savings. Another advantage is scalability. 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 That is to say that computerized data is easily accommodated, okay? Easily accommodate, computerized data easily accommodate the growing needs of business as it expands. Computerized data help the company to handle large volumes of data and transactions. Scalability is easier when you have computerized systems than when you have manual systems. It's easy to expand, for example, the storage of data in a computer system. As the organization grows, as transactions grow, they can easily be accommodated in a computerized system. As opposed to in a manual system where you may be forced to hire new employees, create new spaces for them, they have desks for them, right? And that it can be expensive. It may also take time before that happens. But if you have a computer, scalability becomes very easy. It is easy to accommodate the growing demand or the needs for expansion of a business. Scalability. 7, security. Security. Now, computerized systems come with advanced security features such as encryption, such as access controls, and that protects sensitive financial data from unauthorized use or access. You understand? Security. 8, integration. 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 Now, computerized systems often integrate with other business systems like inventory management or payroll, and that streamlines operations and improves data consistency. It's easy to integrate a computerized accounting system with other systems within the organization, because you see, computerized system it may be used mainly in the finance department, but to integrate the operations of the finance department and other departments, it's easier to integrate the operations of a company of, say, marketing department or stores or inventory management systems or even payroll with the finance department if there is a computerized system in place. So integration becomes easier. You understand? Integrating with other business systems is not only easier, but it can be consistent. And that streamlines operations and improves data consistency. So these are 5 benefits. Let us discuss the drawbacks. What are the drawbacks? The disadvantages of computerized accounting systems. One is cost of implementation. Cost of implementation. The initial setup costs, and these are costs for software, costs for hardware, and training can be substantial, especially for smaller businesses. Number 2, technical issues, technical issues is also a challenge. It is a challenge. System failures, software glitches, or even data corruption can disrupt operations and potentially lead to data loss. 3, learning curve. Now, employees may require training to adapt to new software. They may require time to adapt to the new processes, which can be time consuming, potentially disrupting operations. We are assuming this is an organization that has just shifted from manual system to computerized system. The new employees may require time to learn the new software, to learn the new processes, which can be time consuming. 3, 4, data security risks. Data security risks. Now, while computerized systems offer security features, as we mentioned in the benefits, they are also vulnerable to cyber attacks, requiring constant vigilance and robust security measures. That's the 4th disadvantage. 5, over-reliance on technology. Now, excessive reliance on technology can lead to complacency and lack of understanding of the underlying accounting principles. That is a drawback. 5, there could also be limited customization. Now, some off-the-shelf software may not fully meet the specific needs of a business. Do you understand? Those software that are off the shelf may not meet the specific needs of a business, therefore requiring customization or the development of custom solutions, which can also be costly. Limited customization. So these are the benefits and the drawbacks. We've identified the first benefit in relation to speed and efficiency, accuracy, data accessibility, and organization is easy in computerized accounting systems. Number 3, real-time, to offers real-time reporting. Number 5, there could be cost savings. Number 6, scalability. Number 8, security features. Then integration becomes easier in a computerized accounting system. There are 6 drawbacks that we've outlined. 1 is cost of implementation. Number 2, technical issues. Number 3, learning curve. Number 4, data security risks. Number 5, over-reliance on technology. Number 6, customization. So candidates, computerized accounting system offer significant advantages in terms of efficiency, accuracy, data management, cost savings, scalability, integration, and so on. You understand? And if implemented and managed effectively, computerized systems can be a valuable asset for businesses of all sizes. So that's the end of the lesson. I'm going to read the assignment. 1, list and describe 5 key benefits of using computerized accounting systems in terms of efficiency, accuracy, and control. 2, what are the potential drawbacks or risks associated with computerized accounting systems that organizations should be aware of? 3, how can the benefits of computerized accounting systems be maximized while mitigating the associated risks? 4. Discuss the impact of computerized accounting systems on the role of accountants and auditors within an organization. 5. How do the benefits and drawbacks of computerized accounting systems influence the audit strategy and approach? In our next lesson, we are going to analyze the types of controls in computerized systems. Bye-bye.
Hi there, my name is Patrick Kamau Kamure. You are lecturer in advanced taxation. So I welcome you today to the lesson where we look at a topic called tax investigation. And under the tax investigation, we are going to look at the back duty and in-depth investigation. So when we talk of the back duty, we are talking about the tax that is in arrears or that was in arrears. Back duty, you know, the tax, the duty that is backward, the one that was supposed to be corrected by the KRA from the taxpayer, but it wasn't corrected. So what the KRA normally do, they normally come and look at your books of account and they do a thorough investigation in order to determine your tax position. So in this case, we want to see how is that investigation usually done. In this case, what you also need to understand is that when you talk of the back duty or the tax that is in arrears, and in which case an in-depth investigation is usually done. So in this case, what normally happens is that KRA usually have to come and look at your books of account and determine the taxable income. The taxable income of each of the years. So taxable income in that, if for example you are under investigation for 5 years, so they have to determine what is the taxable income of the first year, what is the taxable income of the second year, third year, fourth year, and the fifth year. And once they determine the taxable income of each of those years, then they multiply by the tax rates. If it is a company, 30%, and then they can be able to get the tax that you are supposed to pay. If you are an individual, then it is graduated, because we know that individuals, it is usually on graduated scales. So it is graduated to determine now the tax that you are supposed to pay. So in this case, we should ask ourselves then, what normally costs the tax that is in arrears? What normally costs the back duty? It is usually as a result of majorly 3 things. One, non-declaration of taxable income, where the taxpayer didn't declare the taxable income for those particular period at all. So the KRA would have come and now determine the taxable income for each of those years. 2, under declaration of the taxable income. It means that you didn't declare the correct amount of the taxable income. For example, you have been earning, let's say, 100,000 per month, but instead of declaring that, and remember we normally declare when you are filing the returns, instead of declaring the 100,000, you declare 50,000 every year. So that means that the KRA will tax you on 50,000. So the 50,000 that you have not declared, that would amount to the back duty when it is taxed. So another one we have where the taxpayer have been over declaring the allowable expense of the business. So remember, expenses normally reduce the taxable profit or income of the business. So if the expenses are overstated, then the taxable profit automatically will come down. So in that case, that means that if the profit is less, then the KRA will come and investigate. Why have you been under declaring the over declaring the allowable expense or under declaring the taxable profit? So in this case, then that means that when they do the investigation and determine the correct amount of the expense you are supposed to deduct, because now you have been over deducting, then that means that this would amount to the tax in arrears, or what we call the back duty. Now, when the in-depth investigation is usually done, the KRA normally use one item to do that. We call it the capital statement. And capital statement, as we are going to see, it is used when we have more than 1 year. The taxpayer has not been declaring their taxable income for more than 1 year, and we are going to see how that capital statement is used to determine the taxable income of the taxpayer. So before we go very far, I'd like us to write something on that. That back duty refers to the tax in arrears That is the tax that was supposed to be paid in the past years but it was not paid. The tax in arrears is usually determined using by the KRA, determined by the KRA by doing an in-depth investigation. In-depth investigation is where KRA take a look at all books of account of the taxpayer to determine the correct tax position. Another point is that back duty stroke tax in arrears can be as a result of the following. One, non-declaration of taxable income. Number two, under declaration of taxable incomes. Number three, overstating of allowable expenses of the business. And the last one I want to add here is claiming expenses or relief one is not entitled to. One is not entitled to. So another point that you need to know is that when determining the tax in arrears, stroke back duty, the commissioner will determine the taxable income of each year from where the tax in arrears will be computed through computation of taxable income and tax rate applicable for the years of income for the taxpayer and the year of income. We say another one is that determination of taxable income where investigation involves several years is done using capital statement. So it's good to know we have talked about capital statement there. And we say capital statement is used where no proper books of account have been kept by taxpayer. It involves comparison of assets and liabilities of business to determine the capital or net assets or net assets or net assets, after which growth in capital or net assets is used to determine taxable income. Capital statement which is used to determine the taxable income has the following format. So I already have explained to you what that means. However, we are saying now, where no proper books of account have been kept, the taxpayer normally use the capital statement, or KRA will use the capital statement to determine the taxable income of the person. Now, once they get the taxable income, then they'll just compute the tax payable by multiplying with the corporate tax rate or the graduated scale rates for the taxpayer, in case it is an individual like those in sole proprietorship or those in partnership. So we are saying that capital statement is usually prepared by comparing assets and liabilities to determine the capital or the net assets, after which the growth in capital or growth in net assets would then be determined, and from there now the taxable income would be determined. So capital statement, we are saying, has the following format. So I'm going to draw for you the capital statement there, see how it is used to get the taxable income. So I leave this space because of the structure of the capital statement, and utilize the space on the other end. So this is how capital statement look like. We have the capital statement. We have the items, and then we have years, which we have year 1, year 2, year 3, year 4. So this will be writing the figures. And so we usually start with the total assets. Total assets. For the total assets, let me write them this way. We start with the total assets. Total assets. So total assets of the business, which we list them here, year 1, year 2, year 3, year 4. And then we less total liabilities. Total liabilities we have for each of the year. Year 1, we less. And that will give us capital. Will give us the capital at end of the year. Capital at the end of the year, we have this for each. Then we less capital at the start of the year. Of the year. And that will give us the growth. Let me write in short, growth in capital or net asset or net accounting profit. Net accounting profit, which will have the amount. Then we add non-allowable expenses. non-allowable expenses for each of the year, and then we less capital allowance, and non-taxable incomes. And that will give you, it will give you the net accounting profit there. So that is how the capital statement look like. We have the name, and then this where you can see we are listing the item, and we list the years, year 1, 2, 3, 4. So what we usually do, we start with the total assets of the business. And when we talk of the total assets, take note we are talking about all the assets of the business, both private and commercial. So not that we may say that because we are looking at the taxable income of a business, we only take for the business only. No, we take the business and the one that are for private, non-commercial. Why are we considering the private? Because it's assumed that this person got the money from the business to finance his private asset. So that's why you take all the assets of the business. And then you raise the total liabilities of the business. Why are we minusing total liability? Which means both business and non-business liability, because this is the owner of the business, and what he's doing is that he cannot be able to differentiate the business, the income, the money that he borrowed for the business and the one he didn't borrow for the business. He can borrow not for business and bring the money into the business. So that's why we consider all the liabilities. So for each of the year, then when you compare the assets minus liability, it will give you the capital at the end of the year. So what we mean is that these assets must be at the end of the year, liability at the end of the year, so that it will give you capital at the end of the year for each of those years. And then you raise the capital at the start of the year. So when the year was starting, how much was the capital? So you come and post it here, post. Now when you say the capital at the end of the year minus capital at the start, it normally gives you the growth in capital or net assets or net accounting profit. Because if, for example, at the end of the year you have 200 million, let me use another current so that you can be able to see. Let's say you had 200 million here, and then that is at the end of the year. At the start of the year, you had 150 million. So it means that now the capital grew by 50 million to 200 million from 150. So the 50 million is the growth in capital, which we normally post there. Now, once you get the growth in capital or net assets or net accounting profit, then you know this net accounting, an accounting profit where now you can use the net profit method to get the taxable income. Net profit method means that we add non-allowable expenses. So non-allowable expense for each of the year, and then you raise the capital allowance. So here you should have added non-allowable expense. One of the non-allowable expense we have run so far is the depreciation. So depreciation you should have disallowed, but now in taxation we allow capital allowance. So we deduct it here. And also if there is an income that is not taxable. And when we talk of taxable, we talk of non-taxable, we mean those that are investment and the operating income, the one that are not taxable. So like now, dividend and interest from abroad are exempted from tax. Interest from a bank for an individual, withholding tax is final. So those that are final and exempt, don't tax them, so we should remove them. So when you take this figure, net accounting profit, add non-allowable less the capital allowance and non-taxable income, it will give you the net taxable profit. So in this case now we can go ahead and tax those particular profit on that particular person or business. So that is how we prepare the capital statement to determine the taxable income. However, it's also important for you to note that if you're given the capital at the end of the year, then you don't have to compare the assets minus liability. You just take the capital at the end of the year, and then now you continue from there at the end minus at the start, and then you continue at the end. So I want us to look at a question to see what we are talking about, the back duty using the capital statement. So I'll have to rub what I have written here so that we can have a space to do the question. This is what the question says. Johnson Shauri has not been maintaining proper books of accounts since the inception of his business in the year 2019. The following balances were obtained from the available business records for 4 years period ended 31st December 2022. So we have the years 31st December 2019, 2020, 2021 and 2022, which we have leasehold property, motor vehicle, furniture, a bank overdraft, loss on sale of investment, account receivable, mortgage loan, inventory, computer, bank account, personal clothes and effects. The following additional information was obtained. Drawings of goods and provision for taxation for the year 2019 were 600,000, 360,000 respectively, and had been accumulating at the rate of 10% annually. A capital allowance were agreed at a total cost of 920 for each of the 4 years. Donation to a political party in the year 2020 amounted to shillings 142,000. Gifts from relative for the year 2021 were 840. Contingent liability in respect of a pending court case in the year 2022 was 1 million. Rent paid on behalf of a close friend was 605,000 in the year 2022. Living expenses were estimated at 800,000 in the year 2019 and had been increasing at the rate of 15% cumulatively each year. We are required, number 1, compute the taxable income or loss of Johnson Shauri for the year ending 31st December 2020, 2021 and 2022. Summarize 3 specific actions that the tax practitioner could undertake upon discovery of an irregularity in the client business. So first we want to get the taxable income, and in this case you can see we have been given several assets of the business, several liabilities of the business, and we are given them the years. There are several years, so we are supposed to get the taxable income for them for the 3 years. So that is 2020, 2021 and 2022. However, now we are also given the column for 2019 because we haven't given the capital at the beginning of 2020. Actually, if you are given the capital for each of the year, in that case we should now start from the capital and now we continue from there. But we are given the assets and liability. So we need the capital at the beginning of 2020, which is the first year of determination of the taxable income. So we need a column for 2019 where we take the assets minus liability to get the capital by the end of 2019. Once you get the capital by the end of 2019, then we can be able to use it in the 2020 as the capital at the beginning of 2020. So this is how the capital statement should look like. So we'll start with the total assets. We list them. The leasehold property is the first one. Which we have 11,760. 11,760 across the board. Motor vehicle. We have 50/40. Furniture. Then we have the loss bank overdraft, that's a liability. Loss on sale of investment, that is an expense. Account receivable is another. Then mortgage loan, that's a liability. Inventory is another. $620, $572, $482, $520. Then we have computers. $620, $720, $840, $720. Bank account is another. $240, $268, $272, $286. Personal cross and effects, those are supposed to be asset as well. Personal effects. Personal cross and effects. $60, $80, $100, $120. So we need to get the total. Before we do that, we also need to look for the total liabilities. Total liabilities, which we have the Roysold No Motor Vehicle Furniture Bank Overdraft. Bank overdraft, where we have 1288, 1400, 1210, and 15. The other one is mortgage loan. $2080, $1840, $1620, and $1500. And those are the liabilities that we have. So we need to get the total. Except there was one more liability, sorry. In the point number 5, there was a contingent liability. Already you are told it's a liability contingent one. So contingent liability. Which we have 1,000 in 2022. And yeah, those are the one that we have. So we'll get the total. We will add them starting from here. So we have 11,760 plus 5040 plus 864 plus 432 plus 620 plus 620 plus 240 plus 60. 19,636. The other one is 11,760 plus 4720 plus 864 plus 544 plus 572 plus 720 plus 268 plus 80. 19,488 The other one is 11,760. We add 9360. We add 864. We add 48. We add 482. We add 840. We add 272. We add 100. 24,086. Go to the last one, 11,760. We add 10,760. We add 864. We add 600. We add 520. We add 720. We add 286. We add 120. We have 25, 630. Then we come here, 1288. We add 2080, which will be 3368. And then 1400. And we add 1840, which would be that 240, 1210 plus 1620, 2830. Then we have 15 plus 1500 plus 1000. That's 615. So now we get the capital at end of the year, which will be now the asset minus liabilities. So for the first one, it will be 19,636, and then we minus 3368, which give us 16,268. The other one will be 19,488 minus that 240, which gives us 16,248. The other one is 24,086, and we minus 2830. 21,256. The other one is 25,630, and then we minus that 615. 22,015. So with that capital we less, and we are calling the capital at the end because these figures are at the end. So we less capital at start of the year. So for the first year, remember, the question was asking we get the taxable income from 2020. So capital for this one, we just required, the end of 2019 mark the beginning of 2020 so that we can come and bring it here. 16,268. Now, the end of 2020 mark the beginning of 2021. So it will be 16,248. This one comes here, 21,256. So this will give us now the growth in capital or net accounting profit. Which will be now this minus this, 16,248. And then we minus 16,268, which gives us negative 20, a loss. The other one will be 21,256. 21,256. and then we minus 16, 248. It will give us 5008. The other one is 22, 015. And then we minus 21, 256. It will give us 759. And then now, this being the net accounting profit, we adjust it by adding non-allowable expenses. Non-allowable expenses. So we go through the question to look for non-allowable expense, starting with whatever has been provided in the list of the item. Leasehold property, motor vehicle. In the middle, there is loss on sale of investment. We don't allow loss on selling of the investment, so we add it back. Loss on investment, which happened in 2020. So it will come here. So dash from here, 100 here, dash, dash. Then we go to the additional information because there is no other fixers, there is no other expense up there. Then additional information, number one, the drawings of goods and provision for taxation for the year 2019 was 600, 360 respectively, and had been accumulating at the rate of 10%. So in this case, we are told for the year 2019, it was 600. That is drawings. And the tax was 360 and had been accumulating. So those are not allowable. Tax drawings are not allowable. So we have the drawings where they should be growing by 10%. So we have 10%. So it means that now, since that was for 2019, for 2020 we'll have 110% of, we take the drawings for the first one, 600. For the other one, if it is for the tax, not for the tax, so we have tax provision, which we have a 110% of 360. So we'll have 110 of 600, which give us 660. So here we should be having 660. Remember 2019, we don't need anything. So 660. The other one would be 110 of 360, 396. And then this one will again multiply by 110 because they are growing by that, times 660. It will give us 726. We multiply again by 110, which gives us 798.6. We come back here, 396 times 110, which gives us 435.6. And then the other one, the same, times 110, which gives us 479. We round off 1602 to one decimal place. Then we continue. Capital allowance, that is not, it's allowable, not non-allowable. Donation to a political party in year 2020 amounted to that. That's not allowable. So donation, political party. Political party, of which case we have a 142 in 2020. The other one is gifts from relative. That's not an expense. Actually, it's an income. So we'll consider it an maybe non-taxable income. Contingent liability, that we had already accounted for under the liability here. The other one is rent paid on behalf of close relatives in 2022. That is not allowable. Rent for relative. Rent for relative, which you have 605. 605. So I like us to continue here So I'll have 2019, 2020, 2021, 2022. A continuation. Then living expenses were estimated to be 800 in the year 2019 and has been increasing at the rate of 15% cumulatively each year. So we'll have living expenses. So we do the same. For the year 2019 was 800, and then you multiply by 115% to know how much would be for 2020. So that will be 800. Then you multiply by 115, giving us 920 times 115, which gives us 1058 times 115, which gives us 1216.7. So we are done with the non-allowable expense. Now we go to the non-taxable income and capital allowance. So we less capital allowance and non-taxable income. So we need the capital allowance and non-taxable incomes. So we are given the capital allowance already in point number 2. Capital allowance were agreed at a total of 920 for each of the 4 years. So we'll have capital allowance. Which we have 920, 920, 920. The only thing that remains is to look for non-taxable incomes. So non-taxable incomes, in the list up there, there is none. Additional information, number 1, there is none. Number 2, none. 3, none. 4, gift. Gift are usually not taxable income, so we need to remove them. Gifts. The gift which came in 2021, 840. Then liability, no. Number 6, rent paid on behalf of close friends, no. Living expense, nothing. So from there we can now get here net taxable incomes. So net taxable incomes, which will start from the loss, so negative 20, and then we add 100, then we add 660, and then we add 396, and then we add 142, and then we add 920, and then now we minus 920, which give us 1278. The next one, 5008, we add 726, we add 435.6, we add 1050, and then we minus 920, we minus 840, which gives us 54, 59.6. The last one, 759 plus 798.6 plus 479.2 plus 6 of 5, and then plus 1216.7, and then we minus 920. We have 2938.5. So this, remember, it is a point. Yeah. So that is the taxable income, and we have already answered the required number 1, where we were supposed to compute the taxable income or loss of Johnson Shauri for the year ending that 1st December 2020 and 2020, 2021, and 2022. So then you are supposed to summarize 3 specific actions that the tax practitioner could undertake upon discovery of irregularity in the client business. So here, so you can do this. This was for Roman 1. Now we have Roman 2. One of the things that you can do is not to notify the client. Notify the client of the irregularity. That is one. Another one is put measures to prevent further irregularity. And the last one, that when you discover there is irregularity in the client business, is to put measures. You can also put measures to prevent recurrence of the irregularity. So that is what you are supposed to do. Discover that there is irregularity in the client operations. So that is how you answer such a question. I'd like us to look at another question, same or about capital statement and back duty investigation. This is what the question says. Peter Chawawa started a retail business on 1st January 2012. He has not been filing income tax returns for the 6 years to 31st December 2017. Now, an investigation of his affairs revealed the following. 1. The balance sheet of the retail business as at 31st December 2012 was as shown below. So we have the fixed fixed assets, which consists of premises 2,000, furniture and fittings 1,000, motor vehicle 500, current assets given, debtors, bank balance, cash in hand. Then total assets. We have the capital as at January 2012, net profit for the year, drawings, mortgage loan, creditors. Number 2, he constructed an extension to the premises in the year 2016 at the cost of 625,000. The following accounts balances were outstanding in the respective years as shown below. So we have the trade debtors, bank balance, trade creditors, cash in hand, stock. He withdrew goods worth 5,000 per month per annum from the business for his personal use. The principal repayment on each mortgage loan amounted to 250,000 per annum from 31st December 2013. The mortgage interest paid in each of the 4 years ending that 1st December 2013, 14, 15, and 16 amounted to 100,000, 75,000, 50,000, and 25,000 respectively. His wife opened a saving account in a commercial bank in the year 2012. The balance in the account after crediting the interest earned were as follows. 2013 all the way to 2017, we have the saving account, interest earned. Then his living expenses and wear and tear allowance were agreed with the Revenue Authority as follows. So we have the living expense, the wear and tear. So we are required to compute annual income of Peter Chawawa from 2013 to 2017. So here again we see that we have been given several assets and several liabilities, and we are required to get the taxable income. So the first thing that we normally take, we note which years are we getting the taxable income. It is from the year 2013 to the year 2017. So now we have to determine if you are given the capital by the beginning of 2013. Yes, it is given in additional information. Number 1, because we are given the balance sheet as at 31st December 2012, which obviously the balance sheet has the capital, the assets, and liability. So if you look at the capital, we cannot talk of 3,000 because that is capital as at January 2012. So we want at the end, which was now that at the beginning capital, net profit for the year less drawings, you get 2,800. That is the capital now at the end of 2012, which marked the beginning of 2013. When the time comes to use it, we'll use it. So the rest we have to now, since we are not given the capitals for each of the year, take the assets minus liabilities. But if you look at the ones that are for each of the year, they are in point number 3, that the following accounts balances were outstanding in the respective years as shown below. So where we have trade debtors, the bank balance, creditors, cash in hand, and stock. But if you look at the characteristics of those assets and liability, they are current one. We don't have fixed assets and fixed non-current liability. So we have to confirm if we had them. Yes, we had them. If you look at the balance sheet of December 2012, there are fixed assets, 3 of them. Those must be carried in the subsequent years automatically. And when it comes to the premise, as per additional information number 2, we have an addition in 2016. So we just add. Otherwise, the others will be the same for those years. When it comes to the non-current liability, we can only find one, the mortgage loan of 1,000 as at 31st December 2012. So that should be in the subsequent years, except that in additional information number 5, we are told that the principal repayment on each mortgage loan amounted to 250,000 from 31st December 2013. So it was being paid 250 every year. So we'll be reducing by 250 every year. Otherwise, we post them as they are. So we'll have Peter, Chawawa, capital statement. So we have the years that we are required to get: 2013, 2014, 2015, 2016, and 2017. As per the required in the computation of taxable income. And I want us to convert them to shillings thousand. We start with the total assets. So first of all, we'll bring forward the non-current assets, which we have premises, 2,000, 2,000, 2,000. But now in additional information number 2, there was an extension in 2016 of 625. It will be 2625, 2625. And then now the other fixed assets, furniture and fitting, 1,000. Then motor vehicle, 500. Then we now bring forward the point number 3, trade debtors, 173, 190, 28, 230.5, 253. Bank balance, which we have 109, 194, 281. 281. Now for the last year is an overdraft, so we put a dash. We have cash in hand. $10. Stock $255. 302.5. 332.5. 366. 402.5. Now there's still another asset in point number 6. His wife opened a saving account in commercial bank in 2012. The balance in this account after crediting the interest earned was as follows. Although they are the wife, it is the wife the account, but we are not told that it was a separate or she was not getting money from the business. Because that is not clear, we have to assume she was getting money from the business being given by the husband. So it should be considered here. Remember we said we consider all assets, both commercial and private. So you'd have saving account. $300, $900, $100, $725, and $750. With no other, we'll get the total. And then we come to the total liabilities. So we start with the non-current liability in the balance sheet on number 1 as at 31st December 2012. We have mortgage loan. So in additional information number 5, we were told that there was a payment of $250 every year. So here 1,000 minus 250 give us 750. Minus 250 again, 500. Minus 250, 250, minus 250, dash. And then now we bring the current liability. In point 3, first we have the bank overdraft. A negative bank account represents a bank overdraft. So which was in the last year here, 32. And then the other one is the creditors, trade creditors. Trade creditors which you have to 30, 241, 253, 272, and 291.5. And then we can get the total. So 2,000 plus 1,000 plus 500 plus 173 plus 109 plus 10 plus 255. 255 plus 300, giving us 43, 47. We do the next one, 2,000 plus 1,000 plus 500 plus 190 plus 194 plus 10 plus 302.5 plus 900. 5096.5. The other one is 2,000 plus 1,000 plus 500 plus 208 plus 281 plus 10 plus 332.5 plus 100. Have 44 31.5. The other one is 26.25 plus 1500. This is already 1500 plus 230.5 plus 281 plus 10 plus 366 plus 725, giving us 5737.5. Next is 2625 plus 1500, that is the 1500 plus 253 plus 10 plus 402.5 plus 750, 5540.5. The other one will be 750 plus 230, 980. Then this will be 741. This will be 503, 272. And then this one is 291.5 plus 32, giving us 323.5. Now we can get the capital at end of the year. That is assets minus liabilities. So it will be 43, 47 plus 980 plus 980 minus, sorry, it should be minus 980, giving us 3367. Next is 50, 96.5 minus 741, give us 4355.5. The other one is 44, 31.5, and then minus 503, 3928.5. The other one is 57, 37.5 minus 272, giving us 5465. 5465, 65.5. Then 5540.5 minus 323.5, giving us 5217. Then now we less capital at the start of the year which for the first year we have to bring the capital that was there, which was 2800. The one in additional information number 1. Now for this one it will be this one, 3367. This one will be 4355.5. This one comes here, 3928.5. And this one, 5465.5. So we'll get the net accounting profit. So we start with this. That figure minus 5465.5, giving us negative 248.5. This one 5465.5 minus 3928.5, 1537. The next one is 3928.5 minus 4355.5 43 4355 4355.5 giving us negative 427. The next one, this one, 4355.5 minus 3367 988.5 3367 minus 2800 567. Now this will now add non-allowable expenses as per the question. Number 1 does not have an expense. Additional information. Number 1 was a balance sheet. Number 2 was an extension. Number 3 were assets and liability. Number 4, he withdrew goods worth 5,000 per annum from the business for personal use. So we have drawings. Drawings are not allowable expense, which we are told each year was 5,000. Since they are shillings 1,000, it will be 555. Number 5, the principal repayment on each mortgage loan was 250 per annum from 31st December 2017. That doesn't have any issue. It's not an expense. It's a loan that was being repaid, but there was mortgage interest. Mortgage is used to construct a residential house. So the interest on mortgage is not allowable because it's not for business, it's for residential. So mortgage interest which we are told it's 100, 75, 50, 25. This didn't have anything. The number 6 is about the saving account and interest earned. That's an income, not an expense. Number 7, there is living expense. Living expense are not allowable. $300, 400, 450, 500, and 600. And wear and tear, that's now, wear and tear, remember, is a capital allowance. Capital allowance. So an unallowable ends there. We now less capital allowance and non-taxable incomes. And we start with capital allowance. We said capital allowance is the wear and tear. So capital allowance or WTA. So we deduct, we have 155.5. We have 130. We have 109. And then 73, 157. The only thing that remains is the non-taxable income. So we continue here, 2013, 2014, 2015, 2016, 2017. So we now look for the non-taxable income. There was only one income in the question. In number 6, interest earned from saving account. That, if you look at what we said when we were looking at the taxation of the business income, interest earned by an individual from a bank is a qualifying interest. Withholding tax is final. So that we need to remove because we should not be taxing it again. So interests from bank saving account, which we have 300, 900, 100, we have 725, and we have 750. The interests are 25. These are saving account. We are looking at the interest, 75, 90, 70, 60. And 60. Now with nothing more, we can get net taxable incomes. So we add them. So we'll start from here. 567 plus 105. This actually 405 plus 405 minus 155.5, and then minus 25. 791.5. Next, 988.5. And then this is 80, 480 plus 480 minus 130 minus 75. 1263.5. Next, negative 425.7. 427. And then this 500, 505 plus 505 minus 109 minus 90, negative 121. Next is 1537. This 525, 530, so plus 530 minus 73, and also minus 70. It will be 1924. Next, negative 248.5. That is negative 248.5 plus 605 minus 157 minus 60. We have 139.5. Yeah, so that is how you determine the taxable income using the capital statement under the tax investigation. So that brings us to the end of this topic. Until I see you in our next the next lesson, see you then. Have good time. Thank you.
Hi students, welcome to another session of manifested online classes. So in this session, I want us to continue with the topic on farm accounting, or accounting for agriculture activities. And specifically, I want us to do an illustration question regarding preparation of financial statements. But before you do that, there is a question which I want to give as an assignment. And that is a question for April 2023, question number 5A. You check on that particular question. It was requiring you give some provisions of IS 41 as far as the measurement of agricultural produce are concerned, and also the disclosure requirement, the information to be disclosed if the fair value of agricultural produce cannot be ascertained reliably. So make sure you attempt that particular question. Equally, if you'll have a challenge in terms of answering that particular question there, I usually encourage my students to acquire this particular revision kit or this revision partner for manifested publishers. You'll be able to get now the solution for the same at the end of that particular book. So therefore, make sure you look on that particular question there. Now, for the purpose of illustration regarding preparation of financial statements, I want us we look on a question which is here, and I can go through it. And the question reads: the trial balance was extracted from the books of David Wekesa, a farmer, as at 31st of October 2019. So we are given the inventory that is on 1st November 2018. This is now the opening inventory for dairy cattle, maize which is growing, dairy cattle feeds, fertilizer for maize, landed buildings, tractors, other cattle which are bulls, and then we have cats which is the net book value purchases for dairy cattle, fertilizer for maize, fertilizer for Napier grass, and then we have maize seeds, dairy cattle feeds. We have sales for milk, dry maize, green maize, dairy cattle, manure, and then we have crop expenses which include labor and other expenses, Napier grass, labor. We have the general expenses. Then we have trade payables. We have capital as all on 1st November 2018, cash at bank, and then we have dairy cattle expenses which include manure, not manure rather, we have medicine, we have labor, other expenses. Then we have some additional information. Number one, you're given the inventory as at 31st of October 2019, which included dry, that is dairy cattle, maize which is growing, other cattle which are bulls, dairy cattle feeds, and then we have fertilizer for planting maize. We have some additional information. Number two, we are told the during the financial year which ended 31st of October 2019, the following distribution of farm produce were made. So we have the farm produce which were consumed by the family members, and then we have the milk delivered to relative hotel. You have to remember how we treat such farm produce. One farm produce which are consumed by the family members, we said this is accounted for as sales and also accounted for as what? As drawings. And then we have the milk which is delivered to relative hotel. This is like farm produce which are delivered or given to close relative. One, we account for that as sales, and two, we account for that as an expense in the general income statement. Number three, we are told manure valued at 600,000 removed from the cowshed and used in the maize plantation. This is what we refer to as the interdependence of department. Output from one department is an input in another department. So in this case, we said the producing department should account for that as sales, whereas the using department should account for that as purchases. Then we have the maize stock valued at 1.5 million used as dairy cattle feed. The same case in the interdependence of department. The producing department account for that as sales. The using department account for that as purchases. Then we are told the cattle bulls are used for pulling carts. So basically carts majorly are used in the farm, and what that means that these particular bulls then are used in the farm. Any information relating to the bull basically will be recorded in maize, or not in the maize rather, in the crop revenue account. And then number 6, you are told depreciation is to be provided on tractors and carts on the reducing balance method at the rate of 25% and 12% per annum respectively. Number 7, you're told income tax is estimated at 3.6. So what you're required to do here, Roman 1, is we prepare revenue accounts. You can see not one account, but two accounts. But from the information, or actually from the information which you're given there, it is important for you to note that David Wekesa was involved like in two farming activities. You can see we are given some information regarding dairy cattle, meaning that David Wekesa was involved in dairy farming, and at the same time we are given information about maize, which is growing, maize which is growing, fertilizer for maize, and so on. So therefore, we can say that David Wekesa was involved in some form of livestock keeping, which are dairy cows. And as a result of that, we have said that you need to prepare a revenue account called livestock revenue account. Also, David Wekesa is involved in growing of maize. In such a case, you prepare something called the crop revenue account. So therefore, here we're going to prepare two accounts, the crop revenue account and the livestock revenue account. Roman 2, the income statement. This, what in other terms we have referred to as general income statement. And number 3, statement of financial position. So we start with the Roman 1 of that particular question, whereby we are required to prepare the revenue account for David Wekesa. So this is the revenue account. The revenue account. And we have said that the revenue account, this one is prepared using a T format. We prepare this using a T format. This will be the debit side. The debit side. Whereas this is the credit side. The credit side. And this particular account will be having two sides. This is the credit, this is the debit. And then we prepare those two revenue accounts concurrently. We have now the crop livestock account. That is the crop revenue account and livestock revenue account. In the same case on the debit side, livestock revenue account and the crop revenue account. The livestock and the crop revenue account. Then the other thing which is important for you to recall here is that in preparing this particular account, we have said on the credit side we record two items. We record the sales and also the opening inventory. On the debit side we record three items: the opening inventory, purchases, and also what and also what we refer to as the expenses, specifically relating to crop and also to livestock. So let's start by recording the sales. And for sales we are given information as far as that is concerned in the trial balance. So we just need to record the sales given here. So we are given the sales one of milk. We are given the sales of milk. So basically milk, this is from dairy cattle. So basically dairy cattle, these are livestock. So therefore that one we recorded in the livestock revenue account. And also important for us to note here that all our figures are in thousands of shillings. All our figures will be in thousands of shillings. Will be in thousands of shillings. So then from there we also have the sale of dry maize. Maize is a form of a crop that go to the crop revenue account. And then we also have a sale of green maize, which is still a form of a crop that go to the crop revenue account. Then we also have a sale of dairy cattle. Dairy cattle, these are livestock. These go to the livestock revenue account, which is a figure of 81. And then from there we also have the sale of what? Of manure. Basically manure comes from what? From livestock, from dairy cows. And that is an amount of what? 3,000. So these are the various items of sales which are given. Then from there, we need to go back to the trial balance because there are other items which we also account for as what? As sales. Like maybe the farm produce which are consumed by the farm workers, by the family members, donated to close relative and so on. So let's go to note number 2. And in note number 2, first of all, we have the maize consumed by family members. Maize consumed by family members. So these we have said is accounted for as sales, and basically these are crops. So that will go to the crop revenue account. We also have milk delivered to relative hotel. Milk to relative hotel. This is also accounted for as sales as far as the livestock is concerned. This is the agricultural produce from the dairy cows. That is an amount of what? Of 4320. Yes. So we have that. And then note number 3 and 4, we have interdependence of department. So number 1, we have the manure, which was valued at 600,000, removed from the cowshed used in the maize plantation. We have said that the producing department now, which is the livestock, will basically account for that as what? As sales. So manure used in maize plantation. So that is sales as far as the livestock is concerned. And that is a figure of 600. And then we also have maize stock. Maize stock used as feeds or used as dairy feeds. Dairy feeds. So that maize stock is a form of came from the farm. The farming or the crop farming or the maize farming will account for that as what? As sales. That is an amount of what? Of 15. So I think that's what we have. Then note number 5, 6, 7 will not affect our sales. So therefore, those are, I think, additional items which you're going to account for as what? As sales. 1, we have seen number 2, the maize consumed by the family members. That is accounted for as sales in the revenue account. Number 4, maize stock valued at 1.5, used to feed the dairy cows. So basically the maize stock come from the farm. That is what? Okay, yes, that will be accounted for as what? As the sales here. As the sales. And then we also have now the manure removed from the cow shed. Yes, so I think that treatment is okay. That treatment is okay. Used in the maize plantation. And also, yes. So then from there, the next item we need to record on this side is the crossing inventory. Because I've said in the revenue account, we record 2 items on the credit side, the sales and also the crossing inventory. Now for the crossing inventory, this one is given in the additional information number 1. So for those particular items, we just need to copy them the way they are, no adjustment. So you have crossing inventory of dairy cattle. Dairy cattle, these are livestock that go to the livestock revenue account. We have crossing inventory of maize which was growing. Maize is a form of a crop that go to the crop revenue account. And then we have a crossing inventory of other cattle, which are bulls. There is some information which are given in note number what? Note number 5, whereby we are told these bulls are used in pulling carts. Carts mostly will be used in the farm. So therefore, these bulls are used in the farm. And that's the importance of that particular point number 5. So these will go to crop revenue account. And then from there we have crossing inventory for dairy cattle feeds. Dairy cattle feeds. So that got to the livestock revenue account, a figure of 1620. And then we have the crossing inventory for fertilizer for growing maize. Fertilizer for growing what? For growing maize. For growing maize.